are you a little short on cash? Well, there's something that may make you feel better, and we've got the information here. You could be eligible for more than $200 from the state of Rhode Island. And our financial planner from Bank Boston, Janet Marcantonio, CFP, is here today to explain. And Janet, thanks for being with us. Sure. What, is this something new?
No, actually, this program's been there for a while. It's just that it's in the past been just for the elderly and the disabled. And now it's available to anyone who makes less than $25,000. That's the income cap. So I think almost everybody would probably know someone that might qualify for this.
And even a student, say, living in an apartment?
Absolutely, that's
like
the nice part. It's for anyone who pays property taxes or rents from someone who pays property taxes.
That almost seems too good to be true.
It does.
This is legitimate, though.
Oh, it's legitimate. There's over $5 million, about $6 million set aside to pay this. It's part of the Rhode Island property tax relief program.
And it's relief for people who are low income. Let's take a look at exactly what the guidelines are. You have to live in Rhode Island.
Yeah, absolutely. For all of 1998, you have to have been a resident. Live in a home that you paid property tax on or that you rented from someone who paid property tax, and you must be current on those property taxes.
Okay.
So that's key. And that the total household income has to be below $25,000.
That's for everybody and only one person per household.
That's right. Okay. That's right.
Show us where you get the form. How do you do this? Make this simple for us.
Very simple. You should have gotten this in the mail, your Rhode Island residential individual income tax form. And just inside it, just past the actual form that you fill out to file your income taxes, is the property tax relief claim form. And it has 5 simple questions, and those are the ones we just went over. Have you been a resident? Do you live in a property?
Yes or no, so you can just check
yes
the
or
box.
No, and that tells you whether you qualify. And if you check yes on all of those, then you go ahead, fill out the rest. It's got a, there is a calculation, a formula as to who gets what. And in fact, they will process the claims of the elderly and disabled first. So they won't even process the claims of anyone else until after June 30th. So this is not going to be immediate that you'll get this money back.
All right, but you could look forward to it before the year is out. You'd be getting the check.
That's right, and depending on how high your income was and how much you paid in property taxes, you can get up to $250.
Up to $250, so it's not a flat fee like that.
That's right, and it'll be a percentage there.
All right, but that's good to know, Janet.
Yeah,
thanks so much for passing that along. We appreciate it on our Money Monday. We want to pass along to you some breaking news that we just found out about. Union workers at Women and Infants Hospital are holding a 2 o'clock news conference this afternoon to announce a rally and informational picket February 6th. They're protesting what union officials are calling management's hostile attitude toward returning workers. The union held a one-day strike, as you may remember, and wound up being locked out for about a month. The issues, pay and benefits. And please don't go away. There is more to come. It didn't stay up late last night. Okay, we're going to practice this for a minute. You're going to see something new. We get them in the mail all the time. A pitch card for a new credit card. So how do you know if it's a good deal or not, or better than you've already got? Well, our financial planner from Bank Boston, Janet Marcantonio, is here with our Money Monday. And I have to admit to you, Janet, I get these in the mail all the time, and usually I just check them because I figure, well, what I have is probably the best. I'm afraid to, check out anything
else. They're really starting to vary a lot. So it is worth going through the disclosure and figuring out what's the best deal for you. Okay. Now, if you're the type that pays off the balance every month on time, all you need to worry about is make sure that you have one that doesn't charge an annual fee and that has the standard grace period to pay your bill. Okay. And that's one of the things on the thing that we can go over.
Well, let's take a look at it here. Okay. We're going to take a look at exactly what comes in the mail. And here's a sample of one from Bank Boston, I take it.
Okay, sure.
Now, what do we want to look for on
here? Well,
here?
first of all, the introductory rate. And for those that don't pay, and this is the average person that doesn't necessarily pay the entire bill every month, you want a good rate. Now, you'll see a lot of those that you get in the mail that say anywhere from 3 to 6%, but it's only a teaser rate. It's for a few months, 3 to 6 months. Then you want to see what does it go up to.
Okay, so introductory rate, we see it right there.
Right,
okay.
And then down a little further.
We see there's a lower rate, right?
It goes up after 6 months. That's the lower rate for the first 3 to 6 months. Then it'll go up to 12%, 15%. So you want to see what it's going to go up to. Unless you're going to start chasing those rates and changing cards every time, see what rate it really goes up to after 3 to 6 months.
Okay.
That's key.
All right.
Next is the grace period that we talked about. They're starting to reduce those on a lot of cards. You want to get one that's at least the 25 days. Don't get one of the ones that's the 20 days because they'll start charging you late fees the minute your payment is after 20 days.
All right.
So you want that 25 days. Now, the late fees is a big one. Back in 1995, the average late fee was a little over $12. Now it's a little over $22.
Okay, so it adds up.
Big
Late
difference.
fees
So
can make
look
a
and see
difference.
what the late fees are.
Okay.
And then also penalty rates. Once you are considered kind of in default, that means you've been late on your payments several times. They'll raise your annual fee. Your annual rate even higher, and that could go up anywhere from I don't know, 12 to 19%.
Okay.
So you really want to check that too.
Read that fine print.
Absolutely.
And then just to balance it against what you already have and see if it is a good deal. And there are good deals out there.
There's some great deals out there, and you just got to do what's right for you, because if you really keep a high balance on your card and you're only paying minimum payments, make sure you're not getting hit with a lot of late fees, high rates.
All right, Janet Marcantonio, thanks so much for helping us out on Money Monday. And they are the newest members of the ABC6 TV News team, but what were they doing on the road? We enjoyed the Winter Wonderland while it lasted. You know, if you're looking for a way to save some extra money this tax season, if you have children, you could get a bit of a break. Our financial planner, Janet Marcantonio from Bank Boston Private Bank, joins us now to tell us how. Is this something new?
Well, yes, it is. This was part of the Tax Relief Act of 1997, effective for 1998. So this is the first time you're filing a tax return that you get to claim this new child tax credit.
You can take advantage of it. Now, you say tax credit, so this is not to be confused with the tax deduction, the traditional thing people think
This
of.
is even better, because this
Really?
isn't just reducing your amount of income on which you pay taxes. You actually do your entire tax return, figure out what your tax liability is, then you apply this credit dollar for dollar against those taxes that you owe.
Well, that's terrific. So
Yeah,
you can do
wonderful.
both. In other words, it's not one or the other. This, if you qualify, you can do both things. Get the tax credit and the tax deduction.
You get your tax deduction for your children, yes,
Right, okay.
absolutely, for your
All right.
dependents, and they have to be dependent.
All right,
to
well, let's
qualify
talk about the
for this.
quality.
Okay,
Yeah, because there's always, you know,
Yeah.
you have to fit the guidelines.
that's right.
How old do the children have to be?
They have to have been under the age of 17 at the end of 1998.
Okay.
That's the first rule. They also, you have to have been able to claim them as a dependent on your tax return.
All right.
The child must be a U.S. resident or a resident alien.
All right, those are all pretty simple things.
Very simple.
Okay, now what are the financial guidelines for the family? There has to be an income, I guess,
That's
base
right.
for
There's
this.
an income cap, and that's the nice part. I mean, just about everyone's going to qualify for this. If you're filing a joint income tax return, your adjusted gross income cannot exceed $110,000.
So that includes a lot of people.
That's a lot of people.
So are people going to take advantage of this, do you think?
Oh, you bet. Now, you know, when you got your 1998 1040 package.
So that grim thing in the mail,
That grim thing in the mail. There is a worksheet.
Okay,
I think it comes out about page 30. It
Okay.
looks kind of complicated, and it is, and you
All
need to work through it, but it is so worth it, because you will be able to claim up to $400 per child under the age
That's terrific.
of 17.
Okay, so look right in there. Now, but it is a bit complicated. That's the only thing.
It's a little bit complicated going through the worksheet, but it's worth it.
Well worth it.
And well worth it. And in fact, you may be able to claim an additional child tax credit if you have 3 or more children under the age of 17.
So this is something people should definitely check out, if not for themselves, with their tax
That's right.
preparer.
And in fact, if you have more than 3 children under the age of 17, I think it's worth talking to a tax preparer, a tax professional, because you have to fill out, in fact, an additional form, the additional child
Okay, so it
tax
gets a
credit
little involved.
form. Gets a little more involved. But again, another $400 can really be worth it. And this one might actually result in an additional refund. The other is just only if you have tax liability do you
Okay.
get that credit. But this one, if you have more than 3 children under that age, you might actually get some money back in addition to reducing your tax.
Child tax credit, don't forget about it this tax
great.
season.
It's a great deal.
All right, Janet, thank you. And by the way, do you want to get a little romantic this Valentine's Day or rekindle an old flame? Well, candles would help make a beautiful setting. We're going to show you how with some creative ideas from a local designer bound to make your Valentine's weekend extra special. That's coming up next. Please stay with us. For ATM machines. But do you know what security is in place to protect you when you go to take your money out at all times of the day or night? Well, we've got some valuable advice from our financial planner, Janet Marcantonio, who joins us live now from the Bank Boston in University Heights with more. And boy, Janet, a federal holiday in particular is a good time to, you know, talk about this, because we turn to the ATM machines for some fast cash.
That's right. It's truly convenient. But the National Association of Bank Security wants you to remember that you are dealing with money, so take a few precautions to make sure you ensure your safety when using an ATM. First of all, if you are going to use an ATM after hours,
select an ATM that's in a well-lit, well-trafficked area and that's not blocked by a lot of shrubbery or other obstacles that obstructs the view from the ATM vestibule.
So this is pretty good where you are now, because there's no, as we could see there was all cement, and you know it's not kind of hidden. Okay.
That's right. Then there are some features in place for your safety. First of all, you have to have an encoded card to get into the ATM vestibule. Have it ready before you get to the door. So don't be fumbling in your pocketbook or in your pocket to get it out. You want to get in and out as quickly as possible. So we'll go in.
Okay.
Use the encoded card, and it buzzes you in. Okay, the other thing to think about is the fact that there are cameras in here for your protection.
Let's take a look at some of the cameras.
Behind each ATM.
Okay.
Used to just film the person in front of the ATM, but now it films everyone behind you as well. So that's a little protection. There's also a phone to the side of the ATM in case you have a problem. Generally, that's there. Doesn't go to the police. It goes to the telebanking center. But if you have some kind of security issue, you certainly could pick that up and they could call 911 for you.
Okay. Let's let you get mic'd up there. So again, you're talking about there's a camera in there, which I think some people might or might not be aware of, but it's good to note that there is somebody watching there, and there is some video being taken. If you're all mic'd up and can hear me and we can continue on, we'd like to find out.
I'm sorry, okay.
That's okay. That's all right. When you walk in the door, this is live TV, folks, so that's the kind of thing that goes on. But Janet, show us some of the other features there. I understand that sometimes inside the booth there's actually either a buzzer if you run into some trouble?
There is not a buzzer actually on the machine, and in fact, the Bank Security Association says that they don't want to go that route because people will tend to think that that's a panic button if they're having just a problem with their transaction, and it can be pushed a lot.
Okay.
So instead, there is the phone. The other thing is, just when you do your transaction, you want to make sure that you take your cash immediately, put it away, don't count it there, wait until you're back in your car or out somewhere safe to count your cash. Don't leave your receipt around either. I mean, that's really key because it's got a lot of key information on it. Just little steps to take to secure your safety.
Okay, and again, there's a phone there if you run into trouble that you can give a call to.
That's right.
Okay.
That's right.
All right, Janet, thanks so much for taking us through that, and we're glad we finally got hooked up there. And
well, I'm going to go get my cash now for the President's Day
Okay,
sale.
good. That's right. We need it today. All right, well, are you looking for something fun to do with the children?
Get through this cold afternoon, so bundle up tonight, Pam. It's the way it looks for now.
All right, we will. And, there is hope if you're working on your taxes and you have kids in college. And we mean hope in terms of a scholarship tax credit. Here on our Money Monday to help us sort it all out and take advantage of some savings is our financial planner, Janet Marcantonio from Bank Boston Private Bank. Janet, thanks so much for being here, as always, on 6 News at Noon. We keep using the keyword hope here. This is something new?
It is something new. It was actually part of the Tax Relief Act of 1997, but it was effective for 1998, so the first time we're all getting to use it is filing our tax returns now in 1999.
All right,
so,
and what is it all about?
Well, there are actually 2 tax credits, the first one being the Hope Scholarship Credit. And that's for, it is literally a tax credit, dollar for dollar, against the expenses that you have paid out for tuition or related costs for kids in their first or second year of post-secondary education. In other words, their freshman or sophomore years in college.
All right, that's a lot, but maybe we can put it up on the screen here so everybody can see it. I guess they're looking at it now, the freshman and sophomore tuition expenses.
Right.
And it's 100% of the first $1,000 you spend?
That's right, and then 50% of the next $1,000 for a total of $1,500 tax
Terrific.
credit. So
All
it's
right.
wonderful, and that's per student per year.
Okay.
And there are income phase-outs. So you have to be within a certain income limit, and I don't know if we have that on the
that's right.
screen
Just tell us about what it is.
If you have anywhere from $80,000 to $100,000 and you're filing a joint return, there's a phase-out in there. So you can get that on the form to figure out if you qualify. And for single, it's $40,000 to $50,000.
So as always, there's a formula. You have a little homework to do here.
That's
okay.
right. So that's the first credit.
Okay.
Then there's another credit. It's called the Lifetime Learning Credit.
Oh, all right.
And that's for not restricted to just kids in their freshman or sophomore years in college. That is equal to 20% of the first $5,000 that you spend on expenses. And that is per family per year. So you can only take that once.
All right.
And that also has the same income phase-out limit.
Now, we're looking at this on the screen. Can you do both of these at the same time?
Yes, you can.
The Hope and the Lifetime
Now, not
Learning?
for the same student.
Okay.
But you can do them both. So let's think of an ideal scenario. You have ideal, it's expensive for you, but let's say you have a freshman, sophomore, and junior in college. For the freshmen and sophomores, you can take up to $1,500 against whatever you spent on their tuition. And then for the one that's a junior, you can take the lifetime learning credit.
Wow, that's great.
It can add up.
Once again, you've got the former, I think, with it. Is it really long and involved thing? Is it pretty straightforward?
Well, it's pretty straightforward, but it is detailed, and it takes some calculating. But it's Form 8863. You need to get the separate form, and if you call 1-800-TAX-FORM, they send it out to you.
Oh, all right. So that's good to know. They'll send it out to you, and then you just fill that all out, and you can make a savings here, a significant one.
Savings.
All right. So parents with students in school, this is time to pay up and listen up. Okay. Thanks so much.
You're welcome.
Janet Marcantonio. And next week on Money Monday, you're going to give us some more information about some education.
There's some more
credits out there that we can certainly take advantage of. Well, the Grammys are just a couple days away, and country superstar Shania.
It's just downright cold out there.
It's chilly. Yeah. All right, Mark. Well, today on Money Monday, Roth IRAs. First of all, there's still time for you to contribute to an individual retirement account. But how will it affect your 1998 tax returns? Well, as always, we turn to our financial planner, Janet Marcantonio, who is here from Bank Boston Private Bank, to help us sort this all out. Let's just start with the basics now. What is a Roth IRA?
Well, that's the newest kind. And again, we have all these changes this year because of that 1997 Taxpayer Relief Act that was passed by Congress.
So changes in a lot of choices.
A lot of choices, because we used to have just the traditional IRA, which was tax deductible. Now there's the Roth IRA. It's named after one of the congressmen that put it through. And this is available to just about everyone. The majority of people will be able to qualify for this. If you're at a certain high income bracket, you won't be able to do a Roth IRA.
Right.
But a Roth IRA is not tax deductible in the year that you contribute to it. You do pay taxes on that money. But the beauty of it is, when you do finally take it out at retirement, there are no taxes at all due.
Okay, let's take a look at just what exactly the Roth IRA is the guidelines for it.
Well, first of all, there's the contribution amount is the same as a traditional IRA, up to $2,000. Now, also new this year is that it used to be if you had a non-working spouse, you could only put in $250 for that spouse. Now you can put up to the full $2,000 for that spouse as well. So you can put up $4,000 for a couple. Also, the Roth is not tax deductible, which the traditional is.
Okay.
There are the income limits of $150,000 for a joint return. So if you as a couple make $150,000 or more, you cannot contribute to Roth IRA. And $95,000 for a single person. But the beauty, like I said, is that it's not taxed at the time of distribution. So to use an example, especially if you're young, in your 20s or 30s, if you were to put away a $2,000 IRA, yes, you pay taxes on it right now. But in 20 or 30 years, it's probably going to more than triple. When you take it out, no taxes due, as opposed to the traditional one.
Where you get taxed when you take it out.
You get taxed on all of it, all the growth on it. So yes, you get a tax deduction this year of $2,000. But when you take it out and it's $10,000, you're paying taxes on that full $10,000.
So for some younger people, you would recommend the
Roth IRA is absolutely the best, and really for just about anyone that's going to keep it in there for more than 10 years.
Okay.
Yeah.
Now, it's not too late, as you say, to contribute to this.
Right.
You have until April 15th tax
April
day?
15th to do your 1998.
And how do you do it? Go to the bank and ask?
To a bank, to a brokerage house. You can do it online if you work on, if you're good on the computer.
You're a computer whiz.
Computer whiz. There's a lot of alternatives out there. So it just depends on what kind of investment vehicle you want to put it in. If you go to the bank, it'll be in CDs. Or you can ask them about their other investment alternatives, and they can turn you to their discount brokerage arm.
Okay.
And then you can put it in stock, mutual funds, bond mutual funds, a choice there.
All right, but we have our financial planners, and now we know the way to go. Thank you so much, Janet Marcantonio, telling us about Roth IRAs today. Well, we switched subjects, and I mean really switched. The Nitro Girls, they're the cheerleaders of wrestling, and today they're going to join us live to tell us. All right, this is March 15th, so a reminder, the tax filing deadline is 1 month from today, and the IRS says it's going to take the average person 22 hours to fill out their returns this year, 2 hours more than last year. So So to help us cut down on the stress, if not the time, we have joining us our financial planner, Janet Marcantonio of Bank Boston Private Bank. And Janet, before we get to your all-important tips, let me ask you about the big story of the day in the banking world. We can't ignore it. Bank Boston and Fleet are merging.
I know.
What is this going to mean for people who bank at these
Well,
places?
it's exciting. It is exciting. I mean, this is the merger of two very dynamic organizations that I think is going to be very good for the overall regional economy because, you know, the resources and the synergies between these two banks coming together, it's going to be tremendous. I think, you know, going into the 21st century, it's going to you know, the power of these two will, you know, the network, for instance, of the ATM networks will be twice what it was. So a lot more...
There'll be customer benefits.
Absolutely.
Then. They don't have to worry.
Absolutely.
People have money at either of these banks. I think they kind of worry a little bit at
You know,
first
this
to
is
hear
very common, these mergers of large banks. And I think we've seen some of them. But, you know, Bank Boston bought Bay Bank just a few years ago, and I think it was a pretty smooth transition for customers. So.
All right, and there's a news conference at 2:30 this afternoon up in Boston, so we'll be learning more about it, and we'll have certainly more at 6 News at 6.
A lot of details to roll out.
All right, well, let's get to our tax tips, because here we got a month to go, so we got to get cracking. If you could give us one vital tip on getting all of our tax stuff together, what would you say to do?
Well, you know, I mean, certainly on getting all your tax stuff together, I think probably one of the biggest things people need to do is to be sure and pull out the last year's tax return when doing this year's tax return, because there are a lot of deductions that people miss because they forget about them. One very common one is loss carryovers. If you had some losses due to sales on capital gains, sales on stocks, mutual funds, properties, you may have taken them last year, but you may have had to not take them all due to IRS limitations. Well, they're not lost.
So take advantage of it now.
You can take them again this year. You can take up to $3,000 against ordinary income.
Okay. Janet, thank you so much for your time today and for helping us to get our taxes together. Take out last year's and we'll be all set. All right. And we're going to come right back with more news for you after this. You know, the IRS says it takes the average person about 22 hours to fill out a tax return. That's 2 more hours than last year. With an investment of that kind of time, you need all the help you can get, and we have it for you today. Our financial advisor, Janet Marcantonio of Bank Boston Private Bank, is live at the IRS office in Warwick today to show us what forms we might need. Janet, what can you tell us? We're all ears.
Well, this is one of the places people can come for help. This is at 60 Quaker Lane in Warwick. There's also an IRS office at 380 Westminster Street. And certainly this year, more than any other year, you may need forms that were not included in your package that was sent to you. In particular, ones that we've talked about are the child tax credit as well as the education credits. So up till now, you've been able to dial the 1-800 tax form number and get the forms sent to you. But going forward, that's going to take 10 business days to deliver them. So you may want to come to the office. The other place that you can get the forms that the IRS suggests is to go onto the internet, which you can do at any library to get the forms that you may need. But that's just to get the forms. You can come here actually for some help as well. They'll actually sit down and answer just about any question you have, be able to go online with your particular account and actually help you fill out your tax return.
Well, this is great to know because a lot of people come up with last-minute questions or they get confused or whatever. Do you need an appointment or can you just show up, Janet?
You can just show up and wait. Right now there's a lull, and there's no waiting at all right this minute, so this is a great time to come. And then, you know, of course, while you're waiting, you can look through all the forms. There's just a whole wall of forms to figure out which ones that you may need. But, you know, if you can't come down to the office and you have some simple questions, you can call a number 1-800-TAX 1040, and they'll answer just about any question you have.
1-800-TAX 1040.
That's
they made
right.
that easy to remember, and they can actually answer your questions. Now, Janet, of course, some of these forms that you mentioned, these are actually things where people can save money, so it's important that they look into these because you might be missing a great opportunity here to get, you know, some credit.
Exactly. In fact, Barbara Shukra of the IRS said that the #1 problem so far, error that they've seen with tax returns that have been filed are people not taking advantage of the child tax credit. That's the one where you can get up to $400 off of your tax bill.
All right, and if you want to know if you qualify, just call in or show up and they'll answer the questions. Janet, thank you so much. You made it a lot more user-friendly for us over at the IRS office.
Great.
All right, Janet Marcantonio for Money Monday. She's from Bank Boston Private Bank. Let's go over to Mark Searles right now. Now, he's in the Weather Center with the forecast for this all-important Easter. was bullish on Wall Street last week. The first quarter of the year ended with the stock market closing above 10,000 for the first time ever. But what does that mean to you, the average investor? Well, joining us for Money Monday, our financial advisor, Janet Marcantonio from Bank Boston Private Bank, is going to give us some meaning to all of this. And if you're not a high roller, exactly what does all that excitement on Wall Street mean?
Well, you know, it doesn't mean a whole lot, but just that there's a lot of volatility in the market. And it also means that the American economic engine is definitely going strong as it keeps growing.
Are we going to be seeing this a lot? I mean, is this going to happen again?
I think in the short term, we're going to see a lot of volatility going up and down. And I think if the short term, that's because we still expect a good correction. It's pulling back some more because of the earnings growth for corporations just can't keep up as fast as they've been doing. So I think there's going to be some correction there. But long term, it's the place to be.
Put on your hard hats like these people and get ready for a good ride. You know, a lot of people don't realize, a lot of times you talk about investments in stocks, and a lot of people say, well, I don't have my money there. My money's all in the bank or, you know, in other kinds of savings things. But maybe they don't realize that this is affecting them.
I think lots of times people don't because, for instance, in their pension plans, if they work for a large corporation, certainly if they're in a 401k, they have investment choices. And they should, if they have their choices, should be in some stock mutual funds, so they are in the market there. Or even if they have a pension plan that's invested for them, most likely a good portion of it is in the stock market.
So is this a good time to invest, though, for people?
Absolutely. Long term. And I think that's the thing to think about, is to be in the market, be in it for the long term. Don't be in and out of it. Don't try and time the market. But if you're saving for retirement, and that's if, you know, even if retirement's only 5 to 7 years away, a lot of people think, oh, I can't be a lot in the stock market. I can't take the risks because retirement's coming so soon.
You're talking about people in their
in their mid-50s, early 60s, and they're thinking, retirement's coming. I can't take the risk of being in the stock market. Well, once you're in retirement, you're going to be there 30 years, and this money needs to support you.
People are living longer. They don't realize that they
Life
could use the money.
expectancies are so much longer, and so you need that growth even during retirement.
How about people, younger families? Should people who have children going to college, is this another group that should look at investing on Wall Street?
You bet.
Okay.
But they need to, those ones do need to look how far away is it that you're going to need that money for tuition. If it's less than 5 years, you probably don't want to be very much in stocks, if any. You may want to be in mid-term bond type investment.
But if you're starting a family, you got a few years to plan.
If you're starting a family and you've got a brand new infant, you've got 18 years. That's going to give you tremendous time to grow in the stock market.
Okay. All right. And, of course, be patient. That's the big thing.
That's the most important thing. And that, in addition to diversifying, don't have all your eggs in one basket. Don't have it all in the stock market. Have a little bit diversified among the 3 asset classes: cash, stocks, and bonds. And the most common way to do that is through mutual funds, but have a little bit in cash, a little bit in a bond mutual fund, and a good portion of it in a stock mutual fund.
We appreciate the advice. Of course, next week you'll be here with the all-important tax day advice, so we'll be all ears. Janet Marcantonio, Bank Boston Private Bank, thanks so much for being with us. Well, you can make big money playing the stock market, as you heard, but you can also play the lottery, too.
You know, say the blue one's for itemizing, pink one for not.
3 more days until the tax filing deadline, and this is no time to make mistakes. So once again, to the rescue, our financial planner, Janet Marcantonio from Bank Boston Private Bank. Don't panic.
Don't panic.
You got 3 days
That's
still.
right.
Okay.
And in fact, if you don't get it done, at least get the form to file an extension. So you can do that.
All right.
You can always do that.
All right. But if you have a 1040 form, what are the biggest mistakes? What do we have to watch out for?
Okay. Well, first of all, I've got the 2 forms here, and there is the 1040, the blue form for when you itemize deductions, and the pink one is the 1040A if you don't itemize deductions. But there's common mistakes and errors that people are making that are applicable to either form.
All right. Let's take a look.
Let's put the 1040 up on the
screen,
and maybe we'll show you. First and foremost, this year your form was did not come with the pre-printed label with your Social Security number.
All right.
And so right there, make sure you fill in your Social Security numbers and do them in the order that the first names, if you file a joint return, in the order that the names are to the left. Okay. Also this year, very new, is the child tax credit that we've talked a lot about.
Right.
And in the area where you are itemizing your dependents, there's a column that has you check off which dependents whoops, down here, here we go.
There we go. Right there.
Which
That's it.
dependents are going to be qualifying for that child tax credit? Be sure and check it out. You don't want to forget the child tax credit. Apparently, #1 mistake people are making.
Really, and you can save so much money that way. It's so important.
Absolutely. And then down in the adjusted gross, at the very bottom of the form,
Okay.
in
So down
the
at the bottom
adjusted
of the
gross
form.
area, it's where you can take the student loan interest deduction. Now, you do not need to itemize.
Get those off. Okay.
Let's get
there we
those
go.
off, and
Okay.
that's right. Right down here where it says student loan, number 15, 16, there we go.
All right, right there.
You want to be sure and fill in if you have taken some student loan, if you've paid some student loan interest. Now, this is really something that a lot of people brush over because this is the first year for it, and they think that only if you itemize your deductions do you get to deduct this interest. No, it's
Not
for anybody.
necessarily. For
That's
anybody.
right. That's
Okay.
right. And then on the back of the form, and let's take a minute
Our
to
form
on
over.
the,
Okay.
on the screen to flip it over, and it's where you fill in the child tax credit.
Okay.
But it also will point out the fact that this year you will have some additional forms you'll need to get for the child tax credit and for any of the learning credits, the lifetime learning credit, the Hope Scholarship credit. And so that brings those out there, Form 8812 and Form 8863. And finally, you know, I'll wrap this up with really important, but believe it or not, people forget to sign their tax returns.
So basic.
So at the bottom of that form,
I think they're so relieved that they've got it filled out that they forget. Okay.
make sure you both
Right down
sign
there.
it. They do ask for your home phone number this year. That's new. And also, if you are having to pay the IRS this year, make your checks out to the U.S. Treasury, not to the IRS. That's new this year.
Okay, so to the U.S. Treasury. And again, if you're not going to make it, just get that extension form in the
That's right.
mail. It's
That's
simple
right.
as that.
It is easy.
Janet Marcantonio, thank you so much
Good
for
luck.
coming to our rescue, our financial planner. By the way, if you do owe any money to the IRS for the 98 tax year, you could negotiate a settlement. We'll be talking a little bit about that later. But first, spring is when designers put out their latest creations. So we decided to take a trip down the catwalk, and you may be surprised at what you'll see. We'll explain next. Well, they say where there's a will, there's a way, and you don't have to be on your way out to consider estate planning. If you're just starting a family, this is extremely important. Now, to explain why and to find out what happens when you don't leave a will, our financial planner, Janet Marcantonio of Bank Boston Private Bank, joins us for Money Monday to tell us. And really, people who are starting a family, this is the time you should actually start thinking about getting a will.
And I think a lot of people think about it, but because they're thinking if they're starting a family, they should, in a will, designate a guardian for their children. And, you know, a lot of people want to designate both a guardian of the person as well as a financial guardian, separate.
And would you recommend that? That's probably good advice. I understand, because if you pick somebody, say an attorney who looks over the money, sometimes they're a little bit more impartial than, say, someone that you leave the child with who might have a vested interest in the money.
Exactly. And, of course, it depends on your assets. But a lot of people don't think about it. A lot of people think, if I have everything in joint name, I don't need to worry about it. What's there to worry about? And it's true. If you have things in joint name, it goes to that joint survivor, your assets. And so, you know, and especially a lot of people say to me, if they don't have children, they're married, they want everything to go to their spouse, they have everything joint name with their spouse. Well, what we've seen happen, unfortunately, a lot, are one of two things. And that is that the second spouse dies in a very short period of time afterwards. And all of those assets will go to that second spouse's family, meaning parents, siblings. And if that wasn't your desire, that all of your assets go to one or the other of the married couple's family upon the death of the survivor of the two of you, another reason you want to have a will.
Also, Jada, without a will, I understand that it has to go to probate court, and it gets a lot more complicated. Is that true?
Absolutely, it does.
So it's better to have it because it's a lot smoother transition, so you can go in peace knowing that the person you wanted to get your money will get it.
Let me clarify there. Okay. With a will, you still go through probate court. The only way to avoid probate is through a trust, or when you have assets that pass by way of a contract, and that is either they're in joint name, or there's a beneficiary designation. And for instance, you need to have a beneficiary designation when you have an IRA, you have an insurance policy, 401k at your work. It is so...
We can take a look at that so we can remind people that, again, there's these are some of the places that you have to check a beneficiary.
And you want to make sure, every once in a while, especially if there's been a change in your family, check
to see what the beneficiary designation is that you have on file, especially if you're going through a divorce or if there's been a death in the of a spouse. Go to the Human Resources Department and find out what you have on file as a beneficiary designation for any company life insurance, 401k. Go to the bank, ask about the IRAs, because
you want to make sure that this is in the name of the person. That
well, you want it to go to the person you want it to go to.
Right.
And especially we've seen it happen with divorces. They didn't change it, and an ex-spouse instead of a current spouse will get the assets.
Or the children or something of that nature.
Exactly.
Is there any place that you can get more information? Janet,
Well, certainly through a trust and estate attorney, and you can call the American Bar Association, the Rhode Island Bar Association, or the Estate Planning Council of Rhode Island to find out. Some banks will have, for instance, in their trust department may
like
have
a brochure
like this that says what happens if I leave no will.
All
Get
right.
some information.
Vitally important. Thanks so much, Janet, from our Money Monday. Well, no one likes... You know, every year, Americans contribute $150 billion to charity. So how can you make sure that your donations count? Well, we turn to our financial planner, Janet Marcantonio from Bank Boston Private Bank, to give us some tips. And Janet, where do we start?
Well, certainly giving is something that we do from the heart, but that's not to say that it shouldn't be something that we do using good business sense. And the American Institute of Philanthropy actually has given a few tips.
They have guidelines on how to
do.
go about this so that you really feel like you are making a contribution.
Right, that counts. First of all, sounds obvious, but never give to a charity that you know nothing about. Decide what kind of causes you want to support. Then go to the library and find out what kind of organizations support those causes.
And
Get a
maybe
list.
contact the organizations themselves and ask them exactly how they'll use your money.
Also, get a list. The IRS every year publishes a list of approved charities. Now, you want to make sure it's on that list if you want to get a charitable deduction for it as well.
Okay.
And then, yes, contact those charities. Now, the large national organizations usually have publications that give information on where things go, how profitable they are, how much of their money goes to their actual programs. And the AIP, American Institute of Philanthropy, says that at least 60% of your donation should go to their programs.
So find out where the dollars go.
Exactly. And then, and if you can't, if they don't have a published report, ask these types of questions. How much do you pay your top executive? Do volunteers do the fundraising, or are they paid fundraisers? Important. And how much does the charity already have? Then another thing might be is to find out, what are some of their recent accomplishments? What have they done in terms of certain programs and support?
And you mentioned, in the beginning, checking out these contributions, because really a lot of people take advantage of your kindness. There's so many scams out there. We recently were talking about in Kosovo, because there's a lot of, fundraising. There's some very worthwhile places to donate your money, but check and make sure.
You bet. Be wary of those hard luck stories when you get a telephone call, and never give your credit card number out over the phone. Only pay by check, not cash. And like I said, certainly not your credit
card. And
card.
only pay to the organization itself and not to an individual.
Directly, exactly. And decide what you can give. Decide what your budget is and stick to it. And don't be pressured by people calling. And the organizations that you like to give to, tell them that they can call you once or twice a year, however frequently you figure out your budget can afford, and then stick to that.
Okay.
Yeah.
Thank you so much for the guidelines. We appreciate it. Janet Marcantonio from Bank Boston Private Bank for our Money Monday. Of course, we taped that a little bit earlier, and now computer owners are double-checking their hard drives today. The latest computer virus was supposed to strike their awareness. The insert, entitled "The Best Defense, The Force of Information Can Beat Breast Cancer," appears in the May issues of Vogue, Glamour, Mademoiselle, Self, and Women's Sports and Fitness magazines. It's sponsored by the Ford Motor Company. This year, though, an estimated 100... Well, the race is on to see who the lucky parents of the first baby of the new millennium will be, and they probably hope to hit the jackpot, because get this, the cost of raising a baby from cradle to college can go as high as $1.5 million. So how do you fit that into your household budget? Well, our financial planner, Janet Marcantonio, is here from Bank Boston Private Bank, and she's going to give us some guidance. And I have to say, I have children, and I think I've lost count because there's so many incidentals. I don't think you actually look at the bottom line total and say, $1.5 million?
I know. Well, and especially when you think about inflation, and the cost of college education far exceeds the cost of inflation, the way it's been rising. So you think about that in 18 years, it's going to be outrageous.
It's scary. So
It is scary.
you start before the baby is born is your advice?
Yeah. First of all, one of the first things you want to look at way before the stork arrives, in fact, maybe even before conception, is to check with your benefits department to make sure you have maternity leave benefits.
Is this something both the mom and dad should do? Because, of course, they get...
Well, whoever covered, whichever plan you're covered underneath. And in some cases, if you don't have coverage for maternity benefits, you know, maybe think about, if you plan well enough in advance, think about increasing or adding to your health care or disability insurance. Look into it and see about getting somebody who has maternity.
Factor that in.
And then you'll, you know, if you're not covered during maternity, you're going to have to adjust your budget. You need to start thinking about that now. How can you do it?
What else?
The other thing to do is to purchase life insurance on both parents. Because even if you have a stay-at-home mom who maybe doesn't bring in an income to the home, something happens, you know, when they die, you're going to have to worry about child care costs.
All right. And you also suggest getting a Social Security number for your baby.
You bet. Immediately. Now they're really good about doing it immediately in the hospital, giving it to you. But I've had some clients who hadn't gotten one for their child when they were 1, 2, 3 years old.
And why is that so important? I think a lot of people might say, well, what does a baby need a Social Security number
Well, to get your deduction on your tax return for them. And now they're being very strict, the IRS. You have to have a Social Security number for that child to be able to claim them as a deduction. And along that line, you want to go again to your benefits department, your payroll department, and change your W-2 to reflect that new deduction.
Okay, and also look at your health insurance policy and get the baby on that as well.
That's right, immediately. And most health insurance policies at a company give you like 30 days to add the new baby. Otherwise, you have to wait until open enrollment. So you do want to make sure you don't forget that. Just make a checklist.
Go right to the office personnel department and check in with them. All right. What about down the line? Now, we're talking about the things you can do in the immediate future, but you're talking about college here, too. So how do you prepare for that?
That's right. It's going to be so expensive. And so I think one of the best things that's come out just within the last 2 years is the Rhode Island Higher Education Trust that's available to everyone. It's a way of saving tax deferred. The other way is through your 401k or other kind of retirement plans that you have.
Because you can take this money out, borrow against it.
You can borrow against it, and now the new tax laws say that you can take it out without any penalties for the use of education.
And that's so important. Thank you so much for helping us cut down on a big expense. All right, Janet Marcantonio, she is our financial planner on Money Monday. Well, thousands of Star Wars fans will be lining up to see, they'd be the first one to see You know, just this Friday, American Power Conversion, which is a Rhode Island-based company, voted to split their stock at the annual meeting. Now, what does that mean for just the average investor? Well, joining us, as always, on Money Monday, our financial advisor, Janet Marcantonio from Bank Boston Private Bank. And Janet, first of all, for the uninitiated, what does it mean when there's a stock split?
It very simply means when a company exchanges one share of its stock for numerous shares, and without changing the overall value of the stock. In other words, if you have a share of stock that's worth $100, they may give you 2 shares worth $50, thus not changing the total value of the investment holding.
Why would anybody do this? Why would a company do this?
Well, you know, you figure going back to the stock market beginning in the early part of this century, if they allowed the value of the shares of stock to just continue to grow, by today, one share of stock would be thousands of dollars, and the average investor couldn't afford to buy a share of stock. So that was a way, it's really just a bookkeeping development.
All right.
A way of making it affordable for the average investor to buy a stock when it gets too expensive.
Right. And yet, a lot of people hear about a stock split and they say, okay, this is a great opportunity, the stock's going to go sky high, and they see this as a ticket to instant wealth.
Exactly. And historically, on average, we see that the minute a company announces that, it does tend to make the company have a rise in its value of its stock.
Because that makes the company sound like it's doing well?
Well, it does, exactly. But in reality, it doesn't necessarily mean anything about how the company's doing. You know, in fact, using American Power Conversion as an example, it announced that it was going to have this vote to split its stock several months ago, and immediately thereafter, just due to factors in the market that really no one can explain, the company really got hit. Its price went down almost 20 points since it announced that. Since its high of 50-something, it's now down in the 30s, low 30s. But it's a very strong, good company. So that really doesn't mean anything. I think the bottom line is decide
whether to buy a company's stock based on the fundamentals of that company.
Okay, the moral of the story is don't look for a stock that you think is going to split, because that doesn't necessarily mean that it's going to go sky high.
Exactly. Look and see if the company has good prospects for earnings, long-term growth. I mean, look at those kinds of fundamentals of the company. Does it have good management? Is it in a good sector of the market that's really performing now? And then, and then what is affordable to you? Now, granted, when it splits, that does make it more affordable. If you couldn't buy 100 shares of the stock at 50, maybe you can now at 25.
So American Power conversion might be something to look into, because you could afford it now where you might not have a few days ago?
Absolutely. That's true.
All right.
That's
so
true.
people are getting a little more stock savvy, and you've helped me to get that way. So thank you, Janet Marcantonio, our financial advisor from Bank Boston. In other news, the U.S. Senate Department is urging Americans planning. All right, want to gain some control over your money and save some at the same time? Who doesn't? And our financial planner, Janet Marcantonio from Bank Boston Private Bank, is here for our Money Monday to tell us how. And I understand the key words start with DD, and we don't mean Dunkin' Donuts.
That's right, direct deposit. You know, it is the fastest, easiest, convenient, secure way to receive electronically payments into your checking account.
I have this, and I have to say it's terrific. You just forget about it, and you don't have to make that trip to the bank. A lot of people, I think, want to make that physical transaction, but it really is, there are a lot of benefits.
Well, there absolutely are. I mean, it's the security and it's saving time of having to go to the bank, and it's definitely the security of not carrying a check into the bank and chance of losing it, etc. And do you realize that your parents are 50% more likely to use direct deposit for their Social Security than we are for our payroll?
And it's a free service, we should point out. It doesn't cost anything. And how simple is it to get it? I think I recall you had to actually fill out a check or something the first time with your employer.
Right,
is that how it
go
goes?
to your Human Resources payroll department and say you want to do direct deposit, and they set it up with your bank. You give them a check, invalid check, and they set it up.
And they set it up for it as simple as that. Okay, so you highly recommend that.
Direct deposit. And then also the flip side to that, which is direct payment.
Now, I'm not as familiar with that, and I don't know a lot of other people are. What is direct payment, and how does it work?
That's where you can get set up to have payments made to, the common payments that you make, utilities, mortgage, different kinds of loans, set up with the company to have them automatically debit your checking account on the due date of
so your
the
bills
bill.
are paid on time, and you get better credit that way.
That's right, and so they are on time, and you have a good record.
There might be some concern, though, about this, because a lot of people are kind of hinky about how they pay their bills, and if there's a dispute or something like that. Now, how does that work when you don't really have a say, because they're automatically taking the money out?
Well, that you do. You have a better record, because it's through your bank, and so on your statement there's the record, and it's easier to track through your bank and to follow up on those when it's automatic debit. And that's for deposit too. The IRS had really recommended direct deposit for your returns this year, and they said that if there was a problem with getting your return, that they could trace it something like 3 weeks faster than if you had sent in a check, maybe even longer.
What about saving money with both of these methods? Is there some hidden cost savings here about like what?
Well, with direct payment, I think the average is that you have 20 bills a month. The average family has 20 bills a month. You average that out, and you spend about $85 a year on postage alone. And then if for some reason you're late on a payment, you may have late fees assessed. You'd never be late if you had direct payment coming immediately out of your checking account. So
and how do you set that up? Same way?
Exact same way. You bet.
Just go to your bank and...
no, go directly to the company. Call your mortgage company, your electricity company, water, whatever, and say, I want to set up on direct payment, and they love it.
They love it. Okay, it'd be better for you, too. All right, Jen, thanks for the tips we want to mention. Next week, she's going to tell us how to deal with creditors when you're over your head in debt. Well, moving along.
Well, it's Money Monday, and Janet Marcantonio joins us, as she does every Monday, with some advice on where to get a big loan if the need comes up unexpectedly. Welcome, Janet, and what advice do you have?
Well, let's take a little quiz. If you had to come up with some money for an unexpected expense, a large amount for a significant expense, would you borrow from your credit card, sell some stock, borrow from your 401k, or take out a home equity loan? What would you do, Marilyn?
I'd borrow from a friend. A very rich friend. No, I know that you're not supposed to do that.
Well, let's go through those four choices, because those are probably the most common choices that people have. And I think the worst choice of all is to borrow from your credit card. Absolutely. In fact, If you took out, say, $10,000 for 1 year from your credit card, it would cost upwards of $1,800 in interest, because on average, credit cards have the highest interest rate that is not tax deductible either.
Right. Wow, that's a lot. 1,800.
Yeah. The best choice would be to take out a home equity loan. Now, that other choice of selling stock, for one thing, you may have to pay capital gains. Let's say if you invested $5,000 in the stock, say 3 years ago, and it doubled to $10,000, that's wonderful, but you have to pay capital gains on that $5,000, which would be about $1,000. And besides which, you're interrupting the growth opportunity that you have on that stock. So that's probably not the best choice.
Right. Okay.
Then maybe the choice, which a lot of people think about, is borrowing from your 401k, which is not a bad choice for a very significant, for instance, college education. Some people do that.
Or for buying a house.
For buying a house. But some things that you have to think about and be aware of, and that is, first of all, the interest rate is not going to be as good as a home equity loan. And also, if you leave the company, you have to pay that back right away. So you need to figure out where you're going to get the funds to pay that back. And the 401k would cost you probably about $875 in interest for a year. And so finally, the home equity loan is really the best.
Right,
and the reason
most reasonable.
It is. And the reason being is the interest is tax deductible. And so even though you'd be paying about the same interest rate as you would for borrowing from your 401k, you get to take the interest off on your tax
How many
return.
home equity loans can you have at one time? Just one?
Well, you can have multiple home equity loans, but only adding up to the amount of equity you have in your home.
Oh, okay. That's
so that's the cap there. And, I mean, it is the best, most cost-efficient way to borrow, but you want to be cautious and remember that your home is on the line, so you don't want to do it for a trip to Foxwoods.
Nothing frivolous.
Nothing frivolous, but for something significant, like an addition to your home, fixing the roof, that kind of thing. Home equity loan probably makes the most sense.
Hopefully some of the people at home for the holiday will take your advice, Janet. Thanks very much. And now let's check in with Mark Searles, who's in the Weather Center, and he brings us the latest forecast. Mark?
And it is a nice one, Marilyn. Boy, I'll tell you, outside temperatures already soaring into the middle 80s.
Did you know nearly 32 cents out of every dollar spent by American families goes towards groceries and household items? And the average is 2 trips to the supermarket a week and 1 or more stops at a drug or discount store. Not surprisingly, the stores are set up to make the cash register ring. But you can outsmart them with your spending. And our financial planner, Janet Marcantonio, joins us live today from Providence with some supermarket savings advice. Janet, nice to have you with us.
Hi, Pam.
Tell us where we begin out in the stores.
Well, we're here at the Super Stop and Shop on Branch Avenue, and there's a lot of shoppers here. And first of all, I don't know how many of them, but what's so important is to plan ahead. And the National Center for Financial Education has given a few handy tips, some obvious, like have a list and stick to it. If you think about it, most grocery stores are set up so that the 4 major food groups are on the outside walls. And the beverages and cookies and nice-to-haves are in the inner aisles. So if you kind of stay away from the inner aisles and stick to your list, you're bound to save more.
All right, make a big loop and try not to go for anything that's not on the list.
That's right. And in planning ahead, when you're doing your list, look for sale items, store sale items, use coupons, use rebates. They really do add up. And also, shop with cash. If you spend cash, if you actually have to go and take money out of an ATM, and like there's a Bank Boston ATM right here in this Super Stop and Shop, if you take money out ahead of time, the cash, you think more about how much you're going to spend as opposed to write a check or use that debit card or credit card.
All right, so bring the cash with you because I think that does tend to keep you back. You
think
say,
it
well,
does.
Maybe I won't get that magazine today or something like that because you want to make sure that you're not embarrassed at the checkout and have to run and go get more money.
You won't do as much impulse spending as you said. That's right. The other thing is to be sure and shop by the unit price. It used to be that bigger was better. And now not necessarily so. So look at the tag underneath the item and shop by the unit price and compare and contrast. And finally, check the checker. I don't think we do that as much, but oftentimes the sale items every once in a while they're not all put into the computer. So when you go through the checkout line, be sure and check what the checker is ringing up, and then when you're done, look at the receipt item again and check it against that to make sure that all those sale items were put into the computer.
Janet, some of the financial experts say you should actually be keeping a tally in your head of approximately how much you think the bill is going to come to also ahead of time.
That would help a lot, too, when you're trying to check that receipt at the end to see how close it came to what you thought you were spending and see how much of the impulse buying you're doing.
Is there any recommendation about coupons, too? I heard they actually are more effective if you can get the smaller size item and use the coupon, which you can't always do. But does that actually work out to be financially advantageous?
Well, I think actual dollar to dollar, you do save more. But then again, you're going to have to go back sooner to buy the item, and you may not have a coupon at that time.
All right. Janet Marcantonio, live out at the supermarket. Thanks so much for being with us today with that advice. Okay. Well, a lot of people might be going to the grocery store today simply to beat the heat. Let's check in with Mark Searles, who's in the Weather Center, with the forecast to fry by.
Absolutely, Pam. It's a good place to go and keep cool, the grocery store. And, I like the middle aisles. That's, of course, where the Tootsie Rolls are kept. So good aisles to go down and check out. Let's check out your almanac. And let's note, shall we, the average high for today? 75 degrees. Yeah, we are.
Plan, the one that you're leaving, that's typically an option. And if they've had good investment choices, you might want to do that. You can transfer it if you're going to a new employer that has a 401k plan. Very typically, they allow you to roll over your plan from a previous employer into their plan, so you can do that.
Okay.
Third, you can roll it over into an IRA rollover. And finally, you can take a cash distribution, which is the worst choice.
Oh, no. And why is that the worst choice? Because I think that's tempting for a lot of people. I'm getting out of this, and maybe I'll just take the money and run.
Well, because first of all, it is taxable immediately upon distribution if you take the cash.
Heavily taxable?
At your current income tax rate. So you figure, on average, immediately 28% off the top. And if you're under 55, well, it depends. If you're retiring, if you're under 55, you pay a penalty. If you're under 59 and a half and you're leaving a company, not retiring, just changing companies, in addition to that regular taxable rate, you have to pay an additional 10%. So conceivably up to 40% that you have to pay taxes on it immediately.
My goodness. So when should you go in and say, what can I do with this? How soon can you do that?
Well, as soon as you know you're leaving. I mean, in some cases you don't want to give the heads up that you're leaving.
Yeah,
So as soon as you know you're leaving, and I really want to tell you the impact of the difference between the two. If and why you want to think ahead, get the forms filled out to do what is called a trustee-to-trustee transfer, not take that cash first. Because by law, you can take a lump sum distribution and roll it over into an IRA within 60 days. And so that may be your plan. You say, oh, give me a check, I'll roll it over into an IRA rollover. Well, now by law, that company has to hold out 20% until you've paid the taxes. And then you have to file with the IRS to get your 20%
Stay with
back.
401k if at all possible.
Stay with the 401k or go into an IRA rollover.
Okay.
It can be a big difference.
And a big savings on Money Monday. Janet Marcantonio, who is our financial planner from Bank Boston Private Bank. Thanks so much for being with us. And now we're going to go check in with Mark Searles, who's over in the Weather Center. More than 95% of homeowners have insurance, so why do the majority of renters risk living without it? And how should you go about getting the best deal on a policy? Well, we turn, as always, on Money Monday to our financial planner, Janet Marcantonio from Bank Boston Private Bank, for some guidance. And, Jen, I guess the big question is, why would people forego getting insurance if they rent? Do they think they're covered under the lease? Is that the deal?
Exactly. I think a lot of times they think they are covered by their landlord. And, indeed, if the landlord is at fault, for instance, if there's a fire and they put in faulty wiring, yes, they're liable, but you have to prove they're liable.
All right.
So lots of times it's the misguided notion that they're already covered.
So what would renter's insurance cover? If you started the fire?
Well, certainly your own liability, and both inside and most policies outside of the home. If you cause harm to someone outside of your home, you have liability insurance. But then in addition, of course, it'll cover any damage due to, wind, fire, earthquake, flood.
Yeah, all of that.
Floods, usually you have to get a separate policy.
Oh, okay. All right.
It also will cover your belongings outside of the home. So, for instance, if you have some very valuable CDs, your whole collection in your car, and your car is burglarized, it will cover the
Your
CDs.
renter's insurance would cover
Your
that.
renter's
All right.
insurance.
Well, let's get the best deal on this. Well, how do you go about it? Let's take a look.
Okay. Well, first of all, you want to determine how much coverage you need by taking inventory of your belongings, and then contact insurance agents and get at least 3 estimates. And then compare the policies for different theft limits because they really vary widely. And then you want to compare the cost of different deductibles. The higher the deductible you can afford to pay, the lower your premium policy is going to be. And finally, to ask about discounts because you can get discounts for
all sorts of different things, security systems, smoke detectors, even special locks if you have them on your home.
So don't forget to mention and say, hey, do you give a deal for this kind of thing?
Exactly.
And how do you determine how much you need? You say you just add up everything that's of value to you, or then plus some, or is there a formula?
Well, usually there are minimum coverage that
Okay.
different companies insist you have. So if your total belongings only come to $5,000, I think the minimum policy typically is around $20,000. So you probably need to be prepared to insure more than you actually need.
And can you give us a ballpark figure for how much this would cost? I know it depends on how much you have.
It really varies very widely. It's not nearly as expensive, obviously, as homeowners insurance because you're insuring the foundation and the land and everything else on which you live. So
Because
it's
that's
just
probably
your
what shies a
belongings.
lot of people away. They think,
Exactly.
gee, I'm just renting, you know, how much do
But
what I
at
need.
tops, a couple $100 a year usually.
Okay. Janet Marcantonio, our financial planner, thank you so much for the advice today. And she's from Bank Boston Private Bank. Well, we want to mention now that it is the summer solstice, and let's check in with Mark Searles, who's over in the Weather Center. He's got the forecast for you. Like that whistle. Well, you know, we're going to learn a little something on Money Monday today about online banking. Just 3 years ago, less than 1 million people did their banking online. 7.5 million people are now on board, and it's going to probably explode from there. It could save you a bundle of time and money, and our financial planner, Janet Marcantonio from Bank Boston Private Bank, is here to help us find out more. Let's begin simply with what is online banking?
It's doing your banking through your computer.
And you told me
Very
that
simply.
people with children are probably the ones that are going to get into this first. That's what happened to you.
Well, that's right, because I'm not that computer savvy, but we had one at home for the kids, and actually got my son to help us figure out how to. You can do it one of two ways. You can either get through your bank the actual software to do it. Most banks provide it. Or you can go through your internet if you have access to it through America Online, AOL, something like that. You can go through the internet with most banks and get onto their website and do your computer banking.
And how did you find it?
It's so easy. It's so convenient. I'm just so sold. It's wonderful.
And you said it's a lot of fun, too.
It really is fun. I mean, especially you can do 3 basic things.
Okay, what can you do if you bank online?
First of all, checking your current balances. You know, you can do that through the telephone. A lot of people think I do that. That's easy. That's convenient. But you can do that online. You can transfer money between different accounts. Nice, easy way to do it as opposed to going to an ATM, going to the bank or on the phone. And finally, paying bills. And this is the biggest one probably that has just exploded.
Do you think this is the biggest time saver, the biggest money
Oh,
saver?
absolutely. Absolutely. Because, first of all, you know, you think about you have to, every month you have to get envelopes, get stamps, go out and mail them. This you just do on your computer. You set up your payees, and you go in and you just click on it. You put in how much you need to pay that month. Some of them you can set up ahead of time if you want to. There's so much flexibility. No stamps. They send automatically out either an actual cash, a paper check.
This is like paperless life, right?
Totally paperless. It's wonderful. Most of the major utilities, the banks are set up with them to transfer the money automatically.
Now, Janet, let's be honest. A lot of people are intimidated. I think this is what got ATM's ways to get going. Some people really like that personal contact. It's very hard for them to decide, well, is it really going to get there? Is my payment going to get there on time? Have you had any problems? Are there any pitfalls you should watch out for with this system?
I can't really think of one because, now, obviously I use the one through Bank Boston, but I think they're all very similar. And for instance, if your check has not been cashed, it comes up with a warning sign the next time you go in to do something to say, you know, in the last 10 days, this check has not been cashed. So it gives you something to think about to, you know, maybe follow up on. But and I've only seen that once, and it was when I was paying an individual, sending out a check to an individual.
An online bank is expected to double within the next couple of years of everybody getting on board.
15 million.
All right, one day you're going to actually sit down at the computer with us here at ABC6 and show us how to do it?
I think that would be fun.
Okay, we'll do that. All right, Janet Marcantonio, thanks so much on Money Monday. Well, Nissan has designed a new vehicle for people who need the passenger space of a sports utility vehicle but want the cargo space of a pickup truck. It's called a sports utility.
Well, it's Money Monday, and that means Money Monday with Janet Marcantonio. Janet joins us now with tips on how to avoid a disaster when your children get their first credit cards. Janet, thanks for joining us and coming in on this holiday.
My pleasure.
So this was a surprise to me. Actually, high schoolers are getting solicitations for credit cards.
You bet. In fact, Consumer Action Agency is saying this summer, credit card companies are out after high schoolers because trying to get a jump on all the kids in college that are getting credit card offers.
This seems like it should be illegal.
Well, you know, and again, most consumer action agencies say that it just really is no reason that a high schooler, you know, or a teenager needs a credit card. So, you know, but
I think a lot of them, because they're getting these ads, they're going to be pestering their parents for the plastic. So,
do you think the best advice is to just say no?
well, if you can, say no. You know, and there are some cases, you know, personally, our teens do have a credit card for our convenience. For when there's things that we need them to get, we don't want to give them cash. But, you know, if you can trust them and you can educate them, and I think that's the very first thing, is first of all, take your credit card statement and talk to them about how this works. First of all, apparently 30% of teenagers don't realize that interest can start from the moment of purchase. You know, so educate them on that. And then the best choice in terms of, you know, what's the best way to do this is not to co-sign on their own card for them.
So what does that mean?
That means if they get an offer in their own name, if they're under age 18, they can't sign a contract on their own. They'll need a co-signer, and that would be you. But the best idea is to get them a second card issued on your own account, because then you can have the bill sent to you, you can establish the prepayment plan with them, and you can even call the card issuer and ask them to set a lower limit on your child's card rather than as opposed to what's on your card.
And should you educate them to pay the balance every month?
Absolutely, absolutely. And in fact, you know, a second choice there might be if they do get their own credit card and you co-sign on it, is to get one that's a secured credit card. We've talked about that, where you secure it with their own savings or checking account. So they have to have enough money in their savings or checking account to match the balance on their credit card.
And that means they lose if they charge too much.
Exactly, exactly. The credit card company can take it right out of their checking or savings account.
Okay, so what other tips do you have along these lines?
Well, the other thing that you might do is, if you think, oh, I just don't want to do a credit card at all, is to consider a debit card. Now, we talked about debit cards before, too, and that's where get them a checking or a savings account, and again, it deducts it directly from the checking or savings account. It's like a plastic check. So they have to have the money in their checking or savings account, or it won't go through. So that's another, you know, possible way of doing it, you know, a good alternative.
So once again, good advice. You can teach your kids something, and you don't have to worry about going broke yourself.
Exactly.
Okay, Janet, thanks again. Now we're going to go out to the Bristol 4th of July parade and see what's going on with Margie O'Brien out there in Bristol. Margie?
Hi there, Barbara. So that's underway right now. Well, it is Money Monday, and Janet Marcantonio is here with your financial checkup.
The U.S. economy is cruising along at warp speed, but how are you doing? Get ready to compare yourself to other U.S. households, coming up on Money Monday.
And if you think you have to be a size 2 to break into modeling, think again. Plus-size model Ann Louise Paolilli will have advice for full-figured women looking for a career on the runway.
And we are enjoying a magnificent...
All right, how do you stack up against the American average when it comes to income, spending, borrowing, and investing? Well, we're going to take a look over the next couple of weeks of Money Mondays so that you can get a comparison and find out where you are. And joining us, as always, our financial planner, Janet Marcantonio from Bank Boston Private Bank. And Janet, first of all, let's talk about income, because I think a lot of people are beating themselves up thinking there's a lot of people out there making six-figure incomes, but statistically, that's not true.
That's not true. I mean, we keep reading all these things about, you know, the mailroom person that wins the lottery, and you know, and CEOs, 22-year-old CEOs that bring this company public and make millions. But what's reality? And reality is that, you know, I think we have some figures that 33% of U.S. households have income of less than $25,000. Now that's significant. A third of U.S. households have less than $25,000, and then almost 2/3 have income of less than $50,000.
So that's the average right there, to give you an idea.
That's right. The average, the actual average, is a little over $39,000 is the average of all U.S. households, and you know, those that are making the six figures, it's really under 10% of U.S. households have, and that's households, that's double incomes even, have greater than $100,000 in income.
So what better reason to have you around to tell us how to invest our money wisely, so that we know what to do? I mean, how does that affect your planning when you look at those
numbers?
I
think that's important, first of all, to say, where am I and how do I compare with everyone else? And then begin to say, all right, now, with that, you know, kind of knowing what my income is, how much money should I have? What should my net worth be right now? And we have some more figures that we can put up there.
Net worth is different now. This is when you look at everything, all of your assets, and then take away all of your debts.
That's exactly it. Add up everything you have and subtract all your debt. And if you're making under $25,000, then the average net worth is around $61,000, and then moving up.
That should make you feel a little better.
It should make you feel a lot better, because the average net worth of all U.S. households is around $76,000. So it's not huge, and in fact we'll talk about what constitutes that in future weeks, you know, what makes it up, the majority of which usually is your home.
Let's talk about it by age, too. Like, where am I in my life, and what are people making compared with me?
That's right, because usually as you get older, your income rises, and so should your net worth. So, again, I think we have some figures that we can put up that, you know, as you're, you know, if you're under 25,000 and your net worth, I mean, under 25 years of age, I'm sorry, income's around 21,000 is the average, and the net worth is only around 7,700. But as you get older,
for any college graduates watching out there, just get out of school.
That's right. You're not going to have much of a net worth, and you can see how dramatically it grows.
And then you see how dramatically it closes, though, towards the end.
Yes.
And now, you don't want to start out where you began or less, so I guess the idea is to look at some ways to financially plan ahead so that you can not drop so dramatically towards the end of your year.
Well, exactly. And you're dropping dramatically because now it's more what makes up the income in those latter years is Social Security. You don't have the income from earned income.
What are we going to talk about next week?
Well, we can talk about budgeting and how much of your your budget goes to different things, and look at U.S. households too. How much are people spending on average on rent or home out of their income?
We're going to need that advice. All right, if you want to review any of this information further so you can be prepared for next week, you can find it on our website at ABC.
Part 2 of your financial checkup.
You know how much money you make, but do you have a handle on where it's going? Well, coming up, you can compare your spending patterns to the average U.S. household.
And this weekend was the Danskin Women's Triathlon in Rentham. We'll hear
Money Monday, Janet Marcantonio will have some advice about your savings bond.
That's right. If you're one of the 55 million Americans that own U.S. savings bonds, you should periodically check the date on them. We'll talk about why coming up.
And we're getting a little taste of...
Okay, more than likely you and your children have some savings bonds safely tucked away for a rainy day. But odds are you have no idea what they're worth right now. So should you be hanging on to them? Well, that's the question this Money Monday for our financial planner, Janet Marcantonio from Bank Boston Private Bank. And Janet, you know, here we are, it's Victory Day. So give us a little history of savings bonds. They actually began in wartime.
They did. Back in April of 1941, President Franklin Roosevelt placed the first order for a U.S. savings bond. So almost 60 years ago.
Are these still a good way to go, or have they become antiquated?
Well, I think right now they're not the best savings vehicle because interest rates are so incredibly low, probably the lowest they've been in 25, 30 years. But, you know, there's always a place for them, and no matter what, I think a lot of us own them. And I think one of the reasons we do is because they're so easy to give. You like to give them when somebody has a baby. That's a great gift. To kids when they're small, grandparents give, etc. So the odds are you have them. But they are so easy just to buy and hold, squirrel away, and lots of times we just forget about them and don't know what they're worth.
So
and
how do you determine that? How good are they for? Usually people just know that they're going to save them for years and years. How
that's
many
right.
years?
Well, to get the face value, and I have one here. This is a $50 U.S. savings bond that was bought in October. You look in the upper right-hand corner, under where it says series, this is a double E bond, October 1986.
Okay.
In general, they reach face value in about 12 years, but they earn interest for 30 years.
Okay, so that's the first thing to keep in mind.
That's the first thing you want to think about. So, and that's, you know, in general, most bonds earned interest. There's a few exceptions, but most bonds earn interest for 30 years. So, in other words, anything that was before August of 1969, date up there, most likely you're not earning interest.
What are the exceptions?
The exceptions are Series E bonds, not double E, but E bonds. That were issued up to November of 1965. They earn interest for 40 years. And then the other exception are double H bonds. They earn interest for 20 years. Now, double H bonds are ones that pay interest every 6 months. They don't just accrue the interest and you get it at the end. They actually pay interest every 6 months. And typically people buy double H bonds by converting their E bonds into double H bonds. You know, for instance, when you're ready to retire, you want income, you've got all these bonds, should you start cashing them in? Well, if you convert them over to double H bonds, you can start getting the interest from them every year without having to pay tons of taxes on the full value of them.
So is that your best advice for what to do with these bonds if they've come into fruition?
Absolutely. If they are no longer earning the interest, either convert them to double H bonds if you can, but you have to do it within a year of when they stopped earning interest.
Okay.
Otherwise,
just cash them in
Cash
and
them
pay
in.
the taxes.
All right. And how do you find out what they're worth? Well, we've got some advice on that. You can check on your savings bond
Try to galvanize.
Monday.
If you're thinking about trading stocks online, beware of margin accounts. We'll talk about why they're so risky coming up.
And it's the world of day trading. Now, this is where individual investors buy volatile stocks online. And to explain how this works and why you have to be extremely careful, we have joining us, as always, on Money Monday, our financial advisor, Janet Marcantonio from Bank Boston Private Bank. And, Janet, explain this to us. There was a recent survey that said some 70% of day traders actually lose money on this. The vast majority do. A very small percentage, something like 11%, know how to make money. You have to know what you're doing.
Well, and especially with day traders, they are trading very volatile stocks. That means ones that are going up and down. And typically they're trading in margin accounts.
And what is a margin account?
A margin account is where you borrow from your broker, in essence, to buy stocks worth more than the money that you have. So they're giving you a line of credit on your brokerage account.
Okay.
And so with day traders, because those stocks are going up and down so fast, and they're doing this over the internet, online, they're putting in an order, and here's what can happen is they put in an order, let's say they're going to buy one of these very volatile, brand new internet stocks, and they want to buy it, they've come out at $10 a share, and so they think they're going to buy 500 shares, they put in an order thinking they're going to spend $5,000. Well, that stock is so volatile that by the time the order gets in, gets processed, it's gone up to $20 a share, and suddenly they've spent $10,000 for this stock when they only expected to spend $5,000, and that triggers a loan immediately. And so one way you can avoid that risk is to put in a limit order, and that states the maximum that you're willing to pay.
All right, let's take a look at that because we have some advice. Here we go. The limit order, the maximum that you're willing to pay. That way, that's almost like when people bid on things online. You can put in a maximum that you'd like to do at an auction or something like that.
Especially want to do that if you're trading online, over the internet, on your computer.
What else? What are some other safeguards?
Well, another way that you can trigger a loan unexpectedly is, and we've seen this happen, is you use your mouse by your computer to place the order. And you perhaps click on, okay, I'm executing this order, and there is a delay in your computer and it doesn't register. So you go and you think it's hung up, and you click it again. Well, you've now placed 2 orders.
Oh. So that's dangerous, too. Okay, so watch out how you place the orders.
And, you know, the real reality check comes in when the stock goes down in price. Because you are now borrowing, you're paying an interest rate, you're leveraging what money you had in there, and you can only borrow up to a certain amount that they give you, and then the price of the stock that you bought goes down, way down below your line of credit.
All right.
So then they do what's called a margin call, and that's where you have to either put cash in or some more stock, but you have to ante up to come up to that limit that you're supposed to keep in there.
So day trading, a lot of risks. We heard a lot of headlines about this in Atlanta with the shootings and how volatile people can become when they get involved in this. Okay, Janet Marcantonio, thanks. By the way, Janet's coming back next week, and she's going to fill us in on the new Private Mortgage Insurance Act next week. Well, you know, you may feel like retirement is a long way off. In fact, less than half of all Americans have put any money aside specifically for that time of life. But how can you get that financial security? Well, here are some easy steps that you can take this Money Monday. Is our financial planner, Janet Marcantonio of Bank Boston Private Bank. Nice to have you with us as always.
My pleasure.
How long do we have to spend in retirement?
On average, a person spends 18 years in retirement. I mean, that's one of the side effects of living longer, obviously.
I just read, in fact, that people should, plan to live into their 90s, and how would they plan for that? But it does seem so far off, and a lot of people don't want to tie up money that way. But you said that's the only way to have financial security.
You know, absolutely. And I think especially it's never too early to start is the first rule of thumb. But, there are a couple of steps that the Savings and Education Council has said that you can begin to take.
All right. What are some of the simple things we could just absolutely start and do this afternoon?
Well, first of all, you've got to kind of have an idea of what are your retirement needs going to be. And that's more important for those that are maybe starting later. If you're in your mid-40s and you're just now thinking about this, you need to begin to get an idea of what you're going to need. And experts say you need anywhere from 70 to 90%. The lower income you have, actually, you need a higher percentage of that in retirement.
Okay.
The second thing is to find out about your Social Security benefits. Now, just starting last year, the Social Security Administration started systematically sending out to all Americans a copy of their personal earnings and benefit statements. But if you haven't gotten one, you can call
Just
in.
call up and get it.
Absolutely, and get
And
it.
find out what your benefits are worth. That's interesting, too. You go to your office, and your personnel office? And,
Exactly, your benefits office, and ask if they have a pension plan, a profit-sharing plan. Find out what your amount is worth. Typically, larger companies will send you an annual statement anyway, but if they don't, you're entitled to one, so by all means do that.
All right, you can gather that information
And
this
find
afternoon.
out if you have any from previous companies,
Ah,
too.
okay, so check with them as well.
That's right.
Okay.
And immediately start contributing, if you can, to a 401k. I know
And
I
you're
preach that
always
so
talking about
often,
that.
but
All right, well, let's take a look at the next set of advice that you have for us. First of all, it's the 401k plan. That's very important. And also putting money into an IRA. Are those the two ways that are best savings?
Betcha. You betcha. That tax-deferred compounding is so powerful. And the earlier you start, the more you're going to have, obviously. And everyone can contribute to an IRA. It may not be tax deductible if you already contribute to a 401k, but at least it still grows tax deferred.
And one more tip for us?
Finally, don't touch your savings. If you're going to leave a company, make sure you roll over the benefits from that 401k if you have one, or even cash balance pension plan, to an IRA rollover. Don't touch it.
Okay, and best of all, you gave us free advice. Nice to get it from the professional. Thanks so much. Janet Marcantonio from Bank Boston Private Bank. And next week on Money Monday, we're going to be talking about how you can avoid being stung by credit card fees. And
That's
those can be
right.
tough. All right. Well, swimsuits, evening. American households now save less than 4% of their disposable income, and that's less than half the rate of at the start of the 1980s. Yet experts say most Americans will need personal savings to supplement retirement income from Social Security and company pensions. So what should you be doing? Well, our financial advisor, Janet Marcantonio from Bank Boston Private Bank, is here, as always, for Money Monday with some fresh ideas for us. Hopefully this won't hurt, because no one likes to save that disposable income. And how much are the experts saying that we really should be saving?
Well, the recommended amount is 10%, because you figure we're living longer and, on average, retiring earlier. So we need more money to last us.
For a lot of people, that's a chunk of change. Let's be honest, when you get that extra money and it's disposable income, it's so much easier to live in the moment and get those things, and you feel like you deserve something. What are some things you can do?
Well, one of the first things is, if you can, maybe think about trying to skip one big expense a year. For example, if you rent a house at the beach every summer, maybe you say, okay, let's only do it every other summer and take day trips to the beach instead. So,
and take that money that you would spend and actually invest it,
put
set
it into
aside.
savings. Set it aside as though you were still going to spend it doing that. Or maybe change from your upscale exercise club to the YMCA.
Or maybe that big trip. Everybody likes to take a big trip every year, same as the beach house type of thing. What's another suggestion that could boost our savings?
One is the high discipline technique of paying in cash. That's amazing how that'll make you see what you really want versus what you really need. And the big difference is you not paying finance charges if you're paying in cash. And as an example, if you were to simply put $700 pay in cash in 1 year, $700 that you would normally put on a credit card that you pay, say, 14% interest rate on, you'd save up to $100 right there.
There you go. So maybe budget aside some cash that you would spend for things during the week that you might ordinarily charge.
Exactly.
Okay. There's something else that we have here called after-debt savings, and this might be a little confusing. What do you mean by that?
Well, that means to keep paying towards your savings after you've paid off your debt. For example, when you come to the end of payments on a loan, car loan, credit cards, keep paying those payments, but to yourself in a savings account.
So you've already budgeted this out anyway. So just say,
Exactly.
once you've paid off the debt, take that same amount every week and put it
That's
aside.
right. That's a great discipline.
Maybe
to
you
start
won't
into.
feel that one
That
so
one you
much.
won't
That
feel
won't
as much
be so
because you've already
bad.
budgeted.
Okay,
another one, a final one, it would be is to earmark any raise that you get at work, and try to save at least half of it. If you figure inflation is only going up by about 2% tops, and most of our raises are anywhere from 3, some people as lucky as 7%, say, I'll take the 2% to add to my disposable income, and the other part I'll immediately put away either into, if you're in your 401k plan, automatically up your 401k plan by anything over, say, 2%. Or put into an automatic savings plan.
A lot of people see that raise as just, oh, here's my chance to go out and spend.
Well,
I've worked for it and I deserve it.
That's right. And you want to upgrade your style of living as well.
So take a little bit of it.
Take half of it. Split it with yourself.
Okay.
And put the rest towards savings.
Good advice. All right. Janet Marcantonio, Bank Boston Private Bank, is going to help us in the years to come if we listen now. That's the idea. By the way, you'll be back next to Money Monday, and we're going to learn more about our earnings.
You know, most of us pay Social Security taxes, but we have no real sense of what our benefits will be. Well, this month you are going to find out. And on this Money Monday, we interpret the information with our financial advisor, Janet Marcantonio of Bank Boston Private Bank. And Janet, welcome. You tell us that this is something that you used to have to ask them for to get the information.
That's right. You had to request it. And they started a couple of years sending them out to older workers, but now starting this week, every year you will be getting a statement from the Social Security Administration, and it will come in about 3 months before your birthday. You can expect to receive it every year. And to give you and your family an idea of your benefits, an estimate of how much your Social Security benefits will be when you retire, should you become disabled, or the survivor's benefit.
And this is really interesting stuff. I mean, it goes way back through your career,
It does.
doesn't it?
It's great stuff. It's a 4-page statement, and on it is a year-by-year listing of your income as reported by your employer to Social Security back from the beginning of when you started working. So it's kind of interesting to look back and see what you were making back in 1977 or, you know, when you were first out of college. But it's really important to check the accuracy of that information.
Now, how do you do that? Because a lot of people aren't really aware what they're entitled to.
Well, you want to just check the accuracy of the listing of your income. And, you know, you may not remember back, but you can start to check against your tax returns over the years.
Right.
And make sure that information is accurate, because that's what the Social Security Administration uses to calculate your benefits. So you won't necessarily know if your benefits are right, only what those earnings were is what you can really check. And then it gives you information on the statement, how to correct it if it's wrong, how to send it back in.
I think are very trusting and not that skeptical. I think you look at it and you say, well, it came from the government. That must be right, instead of saying, no, I don't
that's
know.
right. And especially just look at the most recent years, because that'll give you really a best indication of how it is. And also, you know, you can use this as a projection. You know, we talked about last week, you need to save more towards retirement.
Right.
And this is going to be a real wake-up call to you, because when you see what your estimate of income will be from Social Security when you retire, it's kind of a shock. It's not as much as you would think. And when you use that statement, and also use the statement you maybe get annually from your company on your pension benefits, that will give you an idea of what you can expect when you retire.
Combine those two, and that's what you'll be living on.
That's right. So you know how much you need to really start saving. So use that as a tool in your budget.
How important is it to save this document?
I think it's important to save it from year to year, because that's the nice part. Now you'll be getting a new one each year. And if you really are projecting that your income's going to be a little different in next year, you can actually request specialized ones. And if you go up onto their website, they'll tell you how you can request kind of customized reports. Now, these are going to be very generalized reports, but you can request some customized reports from them as well.
For instance, what kind of a customized report
well,
do you want?
if you're expecting, you know, future income is going to be perhaps you're going to get some kind of big bonus next year, and you want them to factor that in, or in the next few years. Yeah.
All right, so it's coming in the mail. Any other points we should watch for on that?
Well, I think for one thing, if you don't get it, again, you should expect to get it beginning, and like I said, they're starting this week. So this year, if your birthday falls in this year, at least 3 months from now, you should expect to get one this year. If you don't get one, call the Social Security Administration. And really, you know, as always, it's just a good place to start when starting to plan your savings.
Janet Marcantonio, our financial advisor, thanks so much for our Money Monday advice.
And if you want more information from the Social Security website, you can log on to our website at abc6.com.
Invested in annuities, but they're not right for everyone. We'll talk some financial advice. Millions of Americans have invested in annuities, but they're not right for everyone. We'll talk about why coming up. And coming up later tonight after the Rosie O'Donnell Show on ABC 6 News at 6, Amtrak's news an hour. So how is Amtrak taking care of safety? Okay. Well, it is time for Money Monday, and the promise of tax breaks can make investors behave irrationally at times. One mistake many investors can make is buying into annuities when it's just not right for you. Our financial advisor, Janet Marcantonio, joins us today. Give us some insight, and we were joking a little bit before this segment, but I said, all right, what's an annuity? Well, first, simply, by definition, the word annuity means something that's paid periodically in installments. And you think about it in terms of if you buy a lottery ticket, you have a choice of cash or annuity. When Powerball became big, everyone said cash or annuity, and we had to go through what that all meant. And annuity meant you get your payments over time. I think it's over 20 years, equal installments. But an annuity is an investment. It's in a contract that's in an insurance policy, in essence. And you pay into it either with a lump sum or in periodic payments over time. Another way to save your money and make money. Exactly. Okay. Exactly. Now, with an annuity, because it's part of an investment contract, the the investments are tax deferred until you begin collecting on it.
All right, that's a good thing.
That's a great thing.
That's almost like your 401k, right?
Exactly.
Okay.
And so a lot of people, probably the best used for annuity is to supplement your retirement savings. If you don't have a very rich pension plan or 401k, you may also want to do an annuity on the outside.
Okay.
But because it's tax deferred. Well, that's great if you want tax deferred savings, but unfortunately, a lot of Americans have their IRA money invested in an annuity, which if you want tax deferred savings, you already have it with an IRA. You don't need to be invested in an annuity. And that's
So what should you do if you do have a lot of your money in IRAs?
You should be investing in regular stocks, bonds, but not within an annuity contract.
Okay.
Because within an annuity contract, you can either buy a fixed annuity, which the insurance company says will give you a fixed rate of return when you start collecting on this later, or it can be a variable annuity where you pick mutual funds within
All right.
it.
And the last tip here, must hold 12 to 20 years in order to reap the benefits. So this is a long-term goal.
There's a lot of extra costs within an annuity, and that's why it really needs to make sense for you. And I will say, anyone that's already retired or even over 60 years old needs to think seriously before purchasing an annuity, because to truly get a good return on it, equal to what you could do outside of an annuity, you need to hold it for anywhere from 12 to 20 years.
All right,
Long time.
so someone in the middle stages of their life, maybe with small kids or college kids, you might want to start thinking about that now. And the first step to getting into it is contact who?
Any investment person,
Okay.
you know, or your investment advisor, your financial.
Right. Well, maybe it seems too grim to think about, but when was the last time you updated your last will and testament? Or do you even have a will? If you don't, you're not alone. In fact, you're the majority. But this is one case where the majority doesn't rule. And our financial advisor, Janet Marcantonio, is here to explain. Janet, nice to have you with us, as always, on Money Monday. So if you don't make these decisions, who's going to make them for you?
The state.
They step right in.
Absolutely. According to state law, if you don't have a will, if you die without a will, it follows what's called the rules of descent, which are very inflexible.
All right.
And so, you know, there can be some nasty consequences.
Well, what are some of the consequences of not having a will? Because a lot of people say, oh, I know I should have it, but they don't get around to doing
Well,
it.
first and foremost, I think one of the biggest misconceptions, especially husband and wife, assume that everything will go to their spouse, and that is just not the case. If you have assets in your name alone, and you have children, or even, you know, parents or siblings, your spouse may have to share your assets with them.
So they could contest.
It's not contested.
It's not even
the rules
contested.
of
That's
descent
the
say
rule.
that they get split.
All right.
That's
Okay.
right.
That's one thing.
Now,
What's another problem?
But back to that, a lot of people think, well, I have things in joint name with my spouse. And yes, if you have assets in joint name with a spouse, it supersedes the laws of, of a will. So it will go to them. But anything that you might have in your name alone. But even going along that, the next one is that your children, so you may be thinking, well, I have everything in joint name with my spouse. Right. Well, if something happens to both you and your spouse, then it goes to your children. Well, and your children get it by law at 18. Well, if you have significant assets, and they may not be ready for that responsibility. If you have a will, you can set it up so that it goes into trust till certain ages that you determine.
And you can even allow them to have so much at certain ages or whatever, just so they don't go into a spending spree as a teenager and spend it all. Okay.
Exactly. And along that line, if you don't have a will, a probate judge, will appoint who will be the guardian of your children and who will administer your estate.
I think this is when a lot of people start thinking about wills, is when they have children, because that's a big issue.
They absolutely should, because lots of times, again, you assume, well, I only have one sister, one brother. You know, they'll go and they'll say, oh, she always wanted, or they always wanted us to take care of the kids. You know, 9 times out of 10, that will work. I will say that, you know, because the court looks to what your wishes were, and if you can prove intent, but you never know who may come out of the woodwork.
And say, I want the children,
a cousin,
I'd like
and
to
say,
raise
I want
them.
the children, and I'd like to raise them. Exactly. And you may want someone different managing that money for your children, as opposed to being the personal guardian.
So there's no conflict of interest.
So there's no guardian. Right. All right. And finally, if you have significant assets, if you don't have a will, your estate may very well be subject to significant estate taxes if you don't, take care of that.
So their survivors are going to lose out on some money there.
You bet.
Quickly, how much does it cost to get a general basic will? That might be a turnoff for a lot of people.
Well, it very simple, very, very simple will for one person. Shouldn't cost more than a couple of $100s.
Well worth it then.
And very worth the investment.
All right, Janet Marcantonio, our financial advisor. She's going to be here next week to talk about kids and money. But right now, finding out about breast cancer. That can be devastating news, but there's a place you can go for support. We're going to talk to Marlene McCarthy from the Rhode Island Breast Cancer Coalition to find out all kinds of important information for you. Well, as any parent knows, most kids are pros at spending money, but managing it is entirely another story. According to the American Savings Education Council, 94% of students say that their parents are their main source of financial education. So the pressure's on, folks. How can you help your children get some basic training in money management? Well, first of all, listen up to our financial advisor, Janet Marcantonio. She joins us for Money Monday, as always. And Janet, since they learn about handling from the home base, handling money, how do you get them started?
Well, first and foremost, at a very early age, talk about where money comes from and where it goes. I mean, they, very young, can begin to understand that it's a matter of choice and compromise, and that there is not an endless supply to meet everyone's...
Money doesn't grow on trees.
That's right,
okay,
to meet
so
everyone's wants and needs.
maybe when you're out shopping, is that a good time to start talking about with children?
Yeah, and let them know that there's only so much money for not only their toys and candy, but for the roof over their head and groceries, that it's all, you know, everyone, the whole family has to make the choice.
So even a youngster can understand that.
You
Start
bet
young.
they can.
Okay.
And then giving them an allowance.
All right. What would you
always
recommend to someone in the money biz as far as when, and your parent?
Well,
what would you say?
Very early, certainly as early as when they begin to start school. So as early as 5, 6.
5 or 6 years old.
And make sure that you make it very clear what they're expected to cover with their allowance, and make it age appropriate. You know, for 8-year-olds, perhaps they need to pay for their own Pokemon cards, you know.
Okay. All right.
And, you know, the 12-year-old paying for his own theater tickets when he's going with friends to the movies. And along that line, you know, conversely, it's not to put too much money in your child's control.
Okay.
You know, don't let their allowance be for school lunches, for clothing budget, because you may very well find yourself having to rescue them from their bad judgment.
And that's a little overwhelming. So start with maybe
Yeah.
money for their personal expenses is probably the best way to go.
Exactly.
And about how much? Because this is a big debate among parents. For a young child starting out at 6 or 7 years old, what would you say would be an appropriate allowance?
Well, you know, that's really hard to say, because it's what's appropriate for the family and what they can afford.
What would fit in the family budget?
You know, but certainly no more than a couple of dollars. You know, to cover what you think they're going to have to pay for. If they're going to have to pay for, you know, a coloring book, then know what that costs, and think is that, you know, maybe 1 or 2 of that a week or something, and do it back into the amount, perhaps.
What else can you do to make this kind of like a game for kids? Is that important to make it fun as well as
I think so, and something to encourage them. And you might try something like a kid 401k. You know, we think about 401k in our business, where we work, and that is that the company matches what you put in dollar for dollar. So maybe you do that. You say
I
for
love that
every
idea. That's cute.
penny or dollar you save, we'll match it.
So there's an incentive to save as
You
opposed
bet.
to spend
Yeah.
all the time and buy all those little toys.
And it makes them start to have long-term goals. You know, and for the older kid, it's maybe saving for a car when they're as a teenager.
And quickly, do you think they should put it in a piggy bank or take it to the big bank?
Well, I think starting out when it's a very small amount, piggy bank, because you're not going to get any interest at a big bank. But you know, once they've hit a couple of $100s that they've saved up, absolutely start with a basic savings account.
Okay. Any other quick tips?
You know, I think certainly starting to talk to them about investments once they start to get a amount, that would be the next step.
That's the next step.
Yeah.
Okay. And next week we're going to talk about what? Any idea?
Next week I think we're going to talk about getting your credit report and how to correct any errors on it.
Good advice. Okay,
Yeah.
Janet Marcantonio, thanks so much. And when ABC 6 News at noon returns, Mark Searles will give us, as he said, a look ahead to the Halloween weekend forecast. You don't want to miss.
Well, it's better to give than receive. We've heard that enough this holiday season. And now we're going to be talking about a little bit of presents you can get people who try to make your life a little bit easier. Janet Marcantonio, our financial analyst, joins us. So we're tipping for the holiday season.
That's right. You know, there's a lot of service professionals, obviously, tip all year round. It's a $16 billion industry, tipping is. And so we know that to our service professionals, but there's a lot of them that make the bulk of their tips at the holiday season. And so you don't want to be the one to let them down.
Exactly. Let's start with a couple people. Babysitter, someone that's close to your family.
Right. If you 1 to 2 weeks pay is the standard. So if they're there just 1 day a week, that 1 day worth of pay. Same with the housekeeper. If you have them once or twice a week, 1 week's pay. Also a nanny, same thing. 1 to 2 weeks pay is customary.
How about for daycare, where you take your children to that person's house or even an establishment?
Exactly. Well, typically, maybe $15 to $25 you can give in cash and or a gift of that value.
Which do you prefer?
You know, I think that's your own personal preference of how you feel about giving cash, and maybe even finding out from them, you know, maybe from the owner of the daycare, what do the workers prefer.
Mm-hmm.
I mean,
I guess someone, if you had a nanny in your house, you probably know their personalities a little bit better and might find that right gift. But for people that you're not exactly sure what to give, a gift certificate or cash would always be great.
Yeah. And then the hairdresser, who is one that, you know, you want to give something special. They really do look forward to that, and they need that. So if you go not frequently, maybe about a $25 gift is appropriate. But if you really go quite often, every other week or once a month, just the amount that you typically spend on an average visit is a good gift.
Oh,
and some do a gift in addition to that tip is typical. The other thing is, don't forget the newspaper carrier.
Yeah.
You know, usually $15 to $20 is appropriate there.
And many of them have put cards in your newspaper just to let you know who they are.
That's right. And if it's weekly, you want to give the higher amount. If you only get it weekend, obviously give the lower amount. And sometimes you have separate carriers. So keep that in mind and make sure you put the card out at the right time. The other one is the newspaper carrier. The mail carrier. Technically, federal regulations are you cannot give cash, or you can give it, but they're not supposed to receive cash as a gift. And they're not supposed to receive gifts of any value any more than $20. So, you know, ideally give them a gift of some kind. You know, I think I hear some people still slip a little cash in there, and, you know, but make sure that it's no more than $20. Don't get them in trouble.
Okay, some great advice, Janet. Obviously, you don't want to forget anyone that tries to make your life a little bit easier during the whole course of the year.
Yeah.
All right. Makes your holiday season just a little bit brighter as well. Well, let's see how the forecast is looking. Weather is a little bit brighter, too. Here is Fred in the Weather Center for a little bit more.
Just 4 days and counting until we say goodbye to 99 and hello to a brand new year. Now, are you ready to ring in the year 2000 with a fresh financial plate? That's a big question. Janet Marcantonio is here to give us some tips on how to do just that, and it is, of course, Money Monday.
Yeah.
And quite the Monday it is after the holidays, and everyone's sort of in this, we have to get ready for New Year's, but financially, are we ready?
Well,
that's
I think there's a few things that you can still do. You know, December 31st is the date that the tax man determines what your tax liability is for all of 1999.
It doesn't matter after that, does it?
That doesn't matter.
Okay.
So you have a few days left still that you can make a few moves that might limit your tax liability when you come to do
this.
Well, first one that is very obvious for everyone that can do is this is the time of year to be charitable.
Mm-hmm.
So clean out your house of old clothing, furniture, any of those garage sale items. Take an inventory, take pictures for your records, put a market value on them, and donate them to charity.
I never heard to take pictures. That's a good one.
Well, it's a great idea to do
Yeah,
to cover yourself in case you ever get audited.
Okay.
That's the main thing.
Yeah.
And important thing to remember is that for any item over $250, you do need to have a receipt from the charity.
Okay.
So, you know, that's relatively new in the last couple of years.
Okay, that's good.
The other thing you want to do is if you do have a portfolio of stocks, certainly kind of harvest the losses in your portfolio. If you have some stocks you own that haven't done so well, and maybe you're underwater from where you bought them, you can sell them and even buy them back if you wait 30 days and take that loss and offset it either against any gains that you may have taken over the year in your portfolio or just against ordinary income. When you go to file your income tax return, if you have $3,000 in losses from investments, you can offset it against ordinary income.
I didn't know that.
Yeah.
All right.
And any
Another
losses
great
that
tip.
you have, you can carry forward forever. For as many years as you want.
All
The
right.
other thing that everyone can do is you can prepay any taxes and mortgage interest.
Right.
And so, you know, maybe prepaying your first quarter's Rhode Island state taxes, you get that as a deduction for 1999.
On this year.
On
Okay.
this year.
All right.
You know, of course, the
Prepaying.
thing to remember is that if you're, you know, doing it for this year, you may have, you're reducing your tax liability for 99, but then you may not have the same deductions that you need for 2000. So, you know, you need to balance that.
You have to look ahead a little bit.
That's right.
All right.
Some tax steps.
Those are some great tips. So it sounds like we have a little bit of paperwork to do.
Well, that isn't
That and other
included.
things. And then, of course, get ready. Don't leave until the last minute, April 15th, right?
That's right.
Get all your paperwork
We'll
together.
talk
But I
a
like
lot
the
about that
photos.
after the first of the year.
Again, it's $250 if you're going to donate something to charity. If the item is over $250,
you need
have
a
to
written
have
receipt
okay.
from the charity.
All right, that's
You
great.
bet.
All right, thank you, Janet. Moving on, the end of the year means the end of those. We're turning to Money Matters Now, Mark. It's Money Monday, and if you're falling short of your retirement goals, you may be able to take advantage of your most important asset, your home. Janet Marcantonio joins us now with more on this topic. Thanks for being here. Known as a reverse mortgage, I'm going to be honest, I've heard of a remortgage, but not a reverse mortgage.
Well, and it's exactly as it sounds. Reverse mortgage means that the mortgage company, the lender, makes payments to you.
I would like that, but I don't think I'm anywhere near that point yet.
No, it's been around for a while, but it's really been legitimatized in the last couple of years. And what it is, it's for older Americans. You have to be age 62 years of age or older. And for those that really need to supplement their income, perhaps they're really struggling. Or
can I ask what might be a really obvious point? Does your home have to be paid off? Or
Yes.
Okay.
Yeah.
Okay.
Yeah.
So it's obviously it's all paid off.
All
and now
paid
we're
off,
starting to go backwards
which is
a little
very
bit.
typical for older Americans
Right.
at this point, and they've got all this money in their home. And now what we're really seeing is people that are having mounting home health care costs
Right.
and maybe want to stay in the home and not go into a nursing home, have people come in.
Okay.
Where do they get the money to pay for it?
Well, first off, they have to be, you said, 62 years of age or older.
That's right.
And then?
The lender makes monthly payments to them either for a fixed term or for life, or even maybe a lump sum payment up front, or even a line of credit. So there's a lot of flexibility in there. And then you continue to live in the house until you move out of the house, or when you die, then the lender sells the house to
your
pay off the
estate,
mortgage.
so to speak.
Right.
Okay.
But
all right.
there's also a lot of lenders give the opportunity for the family, for children, to step up and take out a new forward mortgage, a traditional mortgage, and take over the house again and buy it back.
So a couple of different options.
Yeah.
You have a note here, high upfront fees.
Yeah, there's some real drawbacks, and that is it is very costly to close on one of these mortgages, and the upfront fees are anywhere from 4 to 8%, so that's
wow.
significant. And often, and there's some limitations on how much they will pay out of the house. It all depends on your life expectancy, the appreciation that may come along in the house, and just what equity there is in the house. And so oftentimes you don't get as much out of it.
Reverse mortgages.
Yeah.
Hopefully we don't have to find out about that too soon, Janet. All right, thank you. Well, the countdown is on. 1 week left to impress your sweetie for Valentine's Day. But as we kick off Valentine's week,
you know, paying down your credit card debt can have a huge impact on your savings, and with a little guidance and a plan, you can make your credit card payments work for you. Here's Janet Marcantonio now with more.
With interest rates having risen, it's more important than ever to pay down your credit card debt. It seems easier said than done, but here are a few suggestions. First, increase your payments. With the average rate on credit cards now over 17% annually, even an extra $20 a month will make a big difference. If you owe $2,000, for example, and pay $60 a month rather than the minimum $40, you'll save almost $800 and pay off the debt in 3.5 years rather than 7. Reassess your investments. If you have funds sitting in a savings account, which generally earns about 3% after taxes, it makes little sense to be paying 17% on credit card debt. Even if you have U.S. savings bonds, CDs, or government bonds, it may pay to sell those and use the proceeds to pay off a credit card. But don't exhaust your savings. Remember that it's always wise to keep an emergency fund with at least 2 to 3 months' worth of living expenses. And finally, use your house. Home equity loans not only charge lower interest rates, but the interest is usually tax deductible. If you have high equity in your home and high credit card debt, then it can make sense. But only use it if you expect to pay off the loan in 6 months to a year. A home equity loan needs to be taken seriously because if you default on your payments, your house is at stake. Once you've paid down your credit card debt, the greater challenge is refraining from building it back up. Cut up your excess cards and keep the one with the lowest interest rate. That's your Saturday Savings Tip. I'm Janet Marcantonio.
And speaking of credit cards, do you always pay your credit card bills on time? Well, the American Bankers Association says more Americans were late with those payments in the first quarter of this year. Overdue credit card accounts increased over last year, but late payments are still much lower than they were back in '96. During that year, they topped it.
People, we get that extra hour of sleep, so don't forget that, Sharon.
Yes, it can be done and easier than you think. Financial planner Janet Marcantonio explains in this week's Saturday Savings.
Today we're talking about maximizing employee benefits. This time of year, companies typically open up their enrollment period for employee benefits. And as an employee, you're asked to make your benefit selections for next year. This is an important decision. A benefit many companies offer, but one that's often overlooked, is flexible spending accounts for medical and child care expenses. These plans can mean big dollar savings to most people. Flexible spending accounts, also known as reimbursement accounts, enable you to use pre-tax dollars to pay for medical and dental expenses not covered by your current plan. You sign up to have an equal amount deducted from your paycheck each month to pay for your anticipated medical or child care expense.
The biggest benefit, no taxes. You don't pay federal, state, or Social Security taxes on that money. And depending on your tax bracket, you can save anywhere from 30 to 40% of the amount you contribute. For example, if your projected out-of-pocket expenses total $1,500, you can end up paying only $900. But you also have to weigh the disadvantages and risks associated with flexible spending accounts. Because reimbursement is made only after you've paid the expense, you may have a temporary cash flow problem. Paying first and being reimbursed later is tough for some on their budgets. But the biggest risk is the use it or lose it rule. You must use all of your contributions by the end of the year or forfeit the remaining amount. So carefully and conservatively, estimate what your medical or child care expenses are going to be. If you use it right, it can be one of your best employee benefits. That's your Saturday Savings Tip. I'm Janet Marcantonio.
For the latest financial news, log on to www.abcnews.com and click on the Money.
Major investment and refinancing can put some added cash in your pocket. Financial planner Janet Marcantonio explains.
If you're the average American, your home is your single largest investment. If it is, you owe it to yourself as a homeowner to consider whether refinancing makes sense right now, given the recent lowering of interest rates. Refinancing is when you take out a new mortgage on your home at a lower interest rate in order to decrease the amount of your payments. If it's been a few years since you first established your mortgage, your first step should be to confirm what interest rate you're currently paying. Check your loan documents or call your lender. Next, check out available loans and interest rates through newspapers or on the internet at www.bankrate.com. Consider what points, if any, you might have to pay. A point is equal to 1% of the value of your loan. Points are paid up front when you close the loan. Finally, assess the mortgage costs involved, such as the origination fee, the appraisal, the credit report, and title insurance. In general, if you can get a new mortgage at a rate of 1 percentage point lower than your current mortgage, you can reap enormous interest savings over 15 to 30 years, depending on how much you borrow. Here's an example. If you refinance a $100,000 mortgage at 7% instead of 8% for 30 years, you'll save about $25,000 over the life of the loan. Finally, if you do refinance and lower your payments, put that savings to work. On that same $100,000 mortgage, if you were to invest the $69 a month you'd save into the stock market, earning the market's historical rate of return of 11% per year, in 30 years, you could have more than $190,000. That's your Saturday Savings Tip. I'm Janet Marcantonio.
And now, ABC's...
Investors are taking a deep breath this weekend after another wild week for the stock market. As financial planner Janet Marcantonio explains, this turbulence is something to be expected.
The recent stock market volatility can try the nerves of even the most seasoned investors. So to help you stay calm when the market goes wild, here are some facts to keep in mind. First, over nearly all long-term periods, 5, 10, 20 years and more, stocks have historically been positive and have been the best investment for outpacing inflation. But don't confuse trading with investing. If you buy stocks with the intention of selling them at a profit in a matter of days or weeks, that's gambling. Market timing doesn't work. In an ideal world, we would pull our money out of the market when it peaked and invest again at the bottom. But nobody has ever been able to do that consistently because we only know the peaks and troughs in hindsight. Staying invested has historically beaten market timing hands down. And another fact is market declines happen. There have been a number of bear markets over the past 30 years, but the length of those bad times pales in comparison to the up periods between them. Finally, nobody knows which area of the market will be the next to outperform. It may be small, mid, or large cap stocks. It may be growth or value style offerings, U.S. or international markets. The best way to potentially benefit from swings in the market is to be invested in various asset classes before the market shifts in their favor. Over the long term, having a diversified portfolio covering several asset classes is the best strategy for weathering turbulent times like these. That's your Saturday Savings Tip. I'm Janet Marcantonio.
And now, ABC 6 Sports.
The recent
recent dive on Wall Street prompted many investors to dump their stocks in favor of low-risk items such as bonds. But financial planner Janet Marcantonio says this may be counterproductive in the long run. She has more on the importance of an investment strategy.
If you were asked to write down your investment strategy on a piece of paper, could you clearly summarize it? Well, many investors can't, and that can lead to trouble. With the stock market having fallen substantially over the past year, many people are moving out of stocks and into more conservative investments. People bought stock in the last couple of years because it appeared that the stock market could only rise. But now, after a year-long decline, it's clear that stocks are capable of falling. So now they're selling and buying something else, such as bonds. Unfortunately, after stocks eventually rise for several months again, those same people will be aching to sell those bonds and buy back stocks. Well, that isn't a strategy. It's not even sensible. If you don't have an investment strategy that you can clearly summarize, then you need to develop one. And you can start by answering these questions. First, what is your investment time frame? If you're investing in stocks, it should be at least 3 to 5 years, and ideally longer. And what is your tolerance for risk? How much sleep do you lose at night when the stock market goes down? Then what are your goals and expectations? What kind of returns are you seeking? Then what is your asset allocation? That is, what percentage of your assets is in stocks and what percentage in bonds? How many stocks or mutual funds do you aim to own? And what will make you sell a holding? Finally, what will make you change your strategy? Well, developing and articulating your strategy will help keep you from moving money back and forth whenever the stock market rises and falls. And that will get you closer to achieving your financial goals. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Not a bad idea.
Okay, thank you very much, Fred. Well, with the recent swings on Wall Street, they've left many investors looking for alternatives to stocks. In this week's Saturday Savings, our ABC6 investment advisor, Janet Marcantonio, takes a look at a new series of U.S. savings bonds.
Series EE U.S. savings bonds have been around for years, but it's their cousins, the relatively new Series I U.S. savings bonds, that are getting an increased amount of attention these days. With the stock market's continued roller coaster ride making a lot of investors queasy, and a spike in energy prices raising concerns about inflation, Series I bonds have some appealing benefits. First, like all U.S. savings bonds, the interest earned is free of any state or local income tax. The interest is normally subject to federal income tax, but not until the bonds are redeemed. And depending on your income level, part or all of the interest may be free of federal income tax if the proceeds are used to pay for college tuition and fees. The bonds can be redeemed after 6 months, but they're really designed as a long-term investment because a 3-month interest penalty applies if you don't hold them at least 5 years. But the most important feature of Series I bonds, and what makes them a potentially better deal than other savings bonds and even CDs, is that they earn a composite interest rate that has both a fixed and variable component. The fixed rate is announced each May and November by the Treasury Department, and that rate applies over the life of all bonds bought in the following 6 months after the rate's announced. The variable rate is based on changes in the Consumer Price Index and can potentially vary as often as every 6 months. The current composite rate for a new I bond is 5.92%. That's compared to 4.5% for a new EE bond. For more information on Series I bonds, check out the Treasury's website at www.treasurydirect.gov. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Still to come on ABC6 News.
Okay, thank you, Fred. Appreciate it. So you have finally settled down after realizing you just won big bucks in the lottery. Wouldn't we all be so lucky? But how should you collect it? What's the best way to manage the winnings and be sure that it stays in your pockets? ABC6 financial advisor Janet Marcantonio joins us now with today's Saturday Savings.
If you didn't purchase a ticket for the big Powerball jackpot last weekend, or at least fantasize a little about what you would do with such a windfall, then you were certainly in the small minority. It wasn't the first mega-sized jackpot, and it probably won't be the last. So what should a winner need to consider before and after claiming his prize? Well, first, of course, you'll have to make the choice between taking your prize in a lump sum cash payment or as an annuity, which is substantially equal payments over 20 years. The amount heralded on the billboards as the jackpot is the annuity amount. If you take the cash settlement, it's a substantially less figure. They give you what's called the present value of the annuity's 20-year stream of income. To make even that first decision, you should solicit good tax and legal advice. A goal for almost every winner is to keep as little as possible from going to Uncle Sam. Not only are there current and future income tax considerations, but also inheritance tax issues that your heirs will face. You may want to set up trusts for your family and maybe even some charitable foundations. After all, with that kind of money, there will be more than enough to take care of your family and friends. You should think about benefiting some worthy causes, which can also claim some tax benefits. So where do you find good advisors? Well, most large banks and brokerage companies have trust departments that work with high net worth individuals. They can refer you to experienced tax advisors and attorneys. For an attorney who specializes in trusts and large estates, you can contact the American College of Trust and Estate Counsel for a list of members near you. Their website is www.actech.org. It's fun to dream, but if you really did hit the jackpot, your team of lawyer, accountant, and financial advisor would suddenly become as important to you as members of your family. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Still because the further away from the coastline you get this weekend, the better weather you'll have.
Better weather for
leaf
looking at
peeping.
the leaves.
That's
All
right.
right, thank you very much, Fred. And if you are thinking about retiring anytime soon, here's some helpful advice. ABC6 financial analyst Janet Marcantonio is here to give us some tips on ensuring a comfortable retirement.
After years of saving for retirement, imagine discovering you don't have enough to live on once you stop working. Your retirement nest egg could crack if any one of these things should happen. You miscalculate your financial needs, you earn a return lower than you anticipated, or you withdraw too much. So what can you do to keep your nest egg intact? Well, first, begin saving for retirement as soon as you start working. If you haven't started saving yet, start as soon as possible and save as much as you can. Even a little bit now can mean a lot more later on. And don't forget that inflation can erode the purchasing power of savings over time. Include at least some stocks in your retirement portfolio to help compensate for investments with lower rates of return. Even in nervous times like we're having in the stock market now, don't abandon stocks entirely. You may want to stick with mutual funds that employ a value style of investing and own stocks that will benefit from falling rates, such as banks, retailers, and healthcare stocks. Know what the value of your investments needs to be on an annual basis if you're going to reach your retirement goal. Then make adjustments to how much you're saving and to your investment allocation to ensure that you're on track. Whatever you do, avoid taking early withdrawals from retirement plans. That could cost you a penalty as well as taxes. And finally, continue to keep a close watch on your investments after retirement. You'll probably need to invest some for income, but continue to allocate a portion of your portfolio to stocks for that hedge against inflation over the long term. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Still to come on ABC6 News Weekend.
I'm a little hesitant to depart.
ABC6 financial reporter Janet Marcantonio has a few pointers for you in this morning's Saturday Savings Report.
Paying for expert advice on financial matters can be a worthwhile expense, especially in these turbulent economic times. One common misconception is that a financial professional can only help you with your investments. The reality is that financial professionals can assist clients with all aspects of their financial lives. Together, you and your financial professional can identify your financial goals, design a budget, outline your estate plan needs, and set tax saving strategies in motion if appropriate. If you want to get the most out of working with a financial professional, here are 5 tips that will help. First, share all your financial data. You can't expect good, solid advice if your financial professional is working in a vacuum. If, for example, you have a certain pool of money you want to invest, your advisor will need to understand where that fits into your overall financial picture before they can determine determine what asset class and level of risk to recommend. Second, trust that your financial professional understands and cares about your future and financial well-being. And be willing to implement recommendations. Then don't be afraid to ask questions, no matter how simple the topic. And finally, arrange to meet at least once a year to review your finances, such as your net worth, asset allocation, and insurance coverage. If you stick to these 5 simple tenets, working with a financial professional may be one of the best financial decisions you can make. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Still to come on